So it's been a couple days since I've seen you. I think we last saw each other on Wednesday. Any interesting things happen in the last couple days that I missed? So good to see you all. What a busy week around the world. Give me just a moment to get my laptop set up here. So if you remember, we were in the midst of a discussion around valuation. And I do want to spend just a moment reviewing valuation from the original perspective that we took it, which was this sweet spot methodology. And then what I'd like to do is the tricky stuff, is get a little bit into venture capital valuation and talk about how it's similar yet different from more of a traditional discounted cash flow model that you would see in a valuation of a much larger company. So if you remember, we talked about the sweet spot methodology as being a two-step process. In step number one, what we do is we assess the amount of cash that we believe the company needs in order to hit the next milestone. So if the company needs a $2 million check to, let's say, build a prototype, or a $5 million check to build out a sales force, there's a cash plan in place. We know how it's going to deploy the capital, who it's going to hire, what it's going to use the capital for. And of course, depending on what stage you are as a company, you're going to have different cash needs. So we start with the cash assessment. And then based on that cash assessment, the founder looks for funding from the appropriate venture capital group. And this is really what the sweet spot was about. Just two variables. Variable number one, how much ownership does the venture capitalist need to exert the amount of control today and in the future based on the dynamics of the company? And there are many things that might drive that ownership percentage. For instance, maybe one of the things that you're thinking through is you like the product, but you feel uncomfortable with the founder. If that's the case, you might feel as if you need to exert more control because there's that lack of trust between you and the founder. Now, I'm not saying there's a complete lack of trust because you probably wouldn't make the investment in that case. But let's just say there's this concern that you have, and so you decide to take on more ownership. The second variable that we look at is the cash, based on where the company's cash needs are. So these are two real variables that matter a lot in a startup. How much control do you need in order to make sure the company makes the decisions that you believe are appropriate for its success? And how much cash does it need based on the next milestone that you think it should hit? This is not the cash needs forever, not till IPO or to the end of the company. This is just to get through the next milestone, to go out there and raise additional capital because you want to make sure this company reaches the proof point that it can reach, that prototype or that extended sales force or that fifth customer, whatever it might be. And if it can't reach the proof point, you've got to ask yourself whether or not this is the right company to continue to invest in. Now, why do these two variables matter so much? Because we know that our ownership percentage, which might be 25%, times the enterprise value, well, that's what our stake is going to be. And if we're putting in 2 million, then we just reverse this equation around. Enterprise value equals 2 divided by 0.25. And we said last week that 2 million divided by 25% is how much? Well, that's no different than what, 2 million times 4? And what's that equal to?
8 million.
It's equal to 8 million. Now, if you remember, I made light of the situation, but there is some truth there. If you have a social gaming company that needs 2 million to get to the next stage, and investors want a quarter of your firm, congratulations, your transaction price is 8 million. Your implied valuation by those two variables is 8 million. You have the cure for cancer, you give away a quarter of your firm for 2 million bucks, congratulations, your transaction price is 8 million. Your implicit valuation by that transaction price is 8 million. You have a pet food company that's going nowhere, but you're able to raise $2 million at a quarter of the firm. Congratulations, the Wall Street Journal says you're worth 8 million. So this model isn't very sophisticated, and clearly those three companies should not be worth the same from an intrinsic value perspective, but they'd all have the same price. And so what we need from that point is then a discussion about where we go next. And that's where a vibrant market really matters. Because if only one company is really looking at this founder for an investment, they're going to use that information and scale the price down. Meanwhile, if there's dozens of investors looking at the company at that price, well, then all of a sudden you're going to start to see a much frothier valuation. So it's not as if the valuation will stay at 8 million. The market sort of dynamic of how much interest there is will start to push that price up or down. And that's what we're going to talk about next, is an intrinsic model that will help us do that. Let me ask you guys one question, which we didn't ask in the last class. And I have to admit, I come from a venture background, so my bias is towards the venture capitalist more than the founder. But why is it important that the founder knows that this is the process that a lot of people use, that these are the two key variables, and that your valuation will be stuck at 8 million? Why is this important for the founder to understand this process? Any ideas? Or just this thought process? Carlos, what do you think?
Important for them to understand, so that when they're, when they're raising capital the next round, they understand what the implied valuation would be.
Okay. I mean, that's helpful, right? If they understand the mechanics, they'll understand these two variables lead to the valuation. Even before we get to negotiations, why is it important for the founder to understand that this is sort of the way the world works? Any other ideas? What do you think?
Do you think it's, David, do you think it's like try to test the market whether the project actually is an interest of some investor?
How so? What do you mean, Chris? I guess I don't understand why would this method be important to a founder if we're testing interest for an investor?
Because sometimes the project or I mean the one that they are doing actually is not worth it in terms of the investor. But if what you say actually is like somebody is doing a pet food, and then it's being they are able to raise a capital of $2 million. Yeah. So it means that say, oh, okay, so my project, there is somebody that is interested and my project have some value, sir.
Yeah, so they could put a value on it that way as well. Let me be a little more specific with my question. Imagine that you walk into an investor that tends to do $1 million investments and tends to take 33% of the firm. That's their sweet spot, Stephen. And you believe you have the cure for cancer. You're going to walk out with what kind of valuation, Stephen, if you do a transaction?
Yes. So that was one of the points I was going to make, is if, at least for pre-revenue companies, there's a lot of creative ways to come up with what you believe the valuation is. And if you understand this is kind of the working basis, you can probably save a lot of everybody's time.
You can, but also, like I said, imagine, Stephen, you really believe that you have the cure for cancer. I mean, you're a doctor who's been studying this for 30 years. You found the genome. Everybody's telling you to raise venture capital. You go to a friend, and that friend's done 1,000 transactions. So you're feeling pretty good about it. But every transaction they've ever done has been $1 million for 33% of the firm.
Yeah. So your value is 3 million, and it's up to you whether you want to accept that or look somewhere else.
Everybody see that? And am I going to get a $200 million valuation from that person?
No.
Probably not, right? Because that person, they have a business model. And their business model says that they invest, $1 million, $2 million. They want 25, 33% of the firm. Their valuation, their price that they're going to transact at is going to be limited, even though the intrinsic value is much higher. So if you really want to get an $80 million valuation, you're going to need someone who writes much bigger checks. You're going to need someone who feels much more comfortable taking much smaller ownership percentages. And, people have their business models. It's not as if anybody's going to write a check at any size. It's just not going to happen. If I have a $30 million fund, I'm not writing a $40 million check. It's that simple, right? If you have a tremendous amount of uncertainty and there's questions about the management team, you're not getting away with a 1% valuation. Unless you're Mark Zuckerberg, but that's a whole nother story. Questions, comments, thoughts? Again, not very practical and not very closely tied to the kind of work we would do in an M&A class or a Corp Val class, but it has a lot of implications if you're a founder about who you start discussions with, even based on what you believe the intrinsic value of your business is, because you're going to be limited on the transaction price based on the business dynamics of the investor and what they feel comfortable with.
David,
Questions, comments? Yeah, thoughts, Rafael?
comment. Good morning.
Good morning.
So probably coming back to your previous class, that's why it's so important perhaps to, when you're discussing with someone, for instance, say, hey, are you speaking to someone else? Yes, I'm speaking to X or Y or Z, because depending on the answer, and people know whether or not you are bullshitting or not, it will imply a certain valuation and a certain stake for the transaction, right? So probably it could help you to tame a little bit the number and tweak it a little bit higher with someone that you're talking to.
Yeah, so 2 points to this, Rafael. Number one, notice we don't have to do with this bond. We don't have to do this with bonds, right? With a bond with, 3-year bond with fixed cash flows, we don't need to go out and talk to 100 different people. I mean, there's an interest rate and, and there's some cash flows, and it's pretty easy to value. Like we don't have a lot of work to do. And so the price is set by the cash flows and by the interest rates. It's not set by anything else, not by how many people are interested. In this environment where there's just so much uncertainty, I think interest really does matter, Rafael. It really matters quite a bit. And we're making it sound easy, right? We're making it sound, well, then just go build a bunch of interest. Well, that's hard to do, right? You've got, 1,000 venture capitalists, but they're located in 1,000 different locations, and they're all very busy people. And this is difficult to do. And that's why hopefully the better companies will come to the top. Because what I will tell you guys, and I don't know whether this is a good thing or a bad thing, but man, do they talk. Do they absolutely talk with each other? And I can tell you this, it was my very first transaction when I was with HarborVest. I was shocked by it because I came in with the impression, Rafael, that these were my enemies, that these were the people that were going to fight me for the deals. And my partner, the person who, eventually became the top guy at the firm, when we looked at a really good company that I was really excited about, he's like, give these 3 other venture capitalists a call. Ask what they think on the deal. Maybe they'll even do a transaction with us. And that was a shock to me, right? So, the good news is there are these connections that do occur between venture capitalists. And so if there is a great company out there, excitement will build quite quickly.
Thank you for the perspective.
Comments, thoughts? Okay, let's continue on. Got a lot to cover in a very short window today.
David, one quick question. Would you say that only the deals that are not the best are the ones that get shared? And if a deal, best in class, the VC will want to just take a larger ownership and not share with anyone else?
So Carlos, if this wasn't a repeat game, I would absolutely say that would be the case. Meaning that if this was just a one and done, of course they would keep the best deals for themselves. And so maybe with a young venture capitalist who's really worried about making their names for themselves, they'll do that. If you're an older venture capitalist, it's sometimes your best deals that you give to other people, because the most important and valuable asset you probably have is your pipeline, right? You want to have access to deals. You don't want to be reading about them in the Wall Street Journal a month later, right? That there was a phenomenal founder with a great idea and you didn't even get a phone call. So Carlos, I think the number one thing that these folks are thinking about, how do they build that pipeline? How do they open as many, connections to great deals as they possibly can? And so again, I think this is one of those areas that's slightly different than others because of that. And by the way, the pipeline today for my children who are going into VC, my MBA students, it's so easy for them. I mean, they have the internet. I mean, Carlos, when I was doing this, we didn't have the internet, and so I sat down at a desk and my boss gave me a phone book and said, go find me some great deals. I mean, it was hard because you had to get out there and build that pipeline from nothing. And today, at least you have, websites and blogs and Reddit. And I mean, there's all kinds of things you can do just from your desk. But back in the day, you had to literally pound the pavement. I mean, I would get in a car and go up and down Silicon Valley and talk to as many people as I could and literally knock on doors. I'm a venture capitalist. I'm here to help. Questions, comments, thoughts? Okay. All right, so let's jump into method number 2, which is the VC method. And this one gets a little bit more technical, and this one is more closely tied to the true intrinsic value of the firm versus just a transaction price that's implied by certain ownership stakes and cash flows. The VC method is going to be very much like a traditional discounted cash flow method, except for it's going to simplify in many areas and really come down just to 4 fundamental issues. And this is where it gets a little complicated. Number 1, we're not going to look at year-by-year cash flows. Hold on one second. Sorry about that. Morning wake up. People are looking for the dog. They don't know where she is. So the exit valuation is going to be the way we look at this, is very much like a transaction. So we make an investment today, and in 5 years, we're going to leave this transaction. 7 years, we're going to leave this transaction. What do we think the company is going to be worth then? So we're going to have some kind of forecast. How large is the company going to be? How profitable is it going to be? What can it liquidate at? So we need some kind of perspective on what we think the exit valuation will look like. That's number 1. Number 2, how much will we own in 5 years? And you might say, well, won't we own whatever we own today? The answer, of course, is no. If the company needs additional cash in order to get where it's going to go, you're going to have to do additional fundraising. That fundraising is going to give away 20%, 30% of your firm at a time. You might start with a 30% ownership stake. You might end up with a 5. So we have to think about what kind of capital we're going to have to raise between now and then. Number 3, we're going to have to come up with a discount rate. But unlike every other class at Wharton, we're not going to use the weighted average cost of capital. Instead, we're going to use something called the target rate of return that incorporates a probability of failure. And I want to show you how to do this robustly and have much better conversations than we're currently have. And this is where it gets tricky. So we'll talk about the cost of capital versus a target multiple. And then finally, number 4, we'll do our comparison. What's the implied valuation from our model? And what's the current market price, right? What's the investment that's required? And that's when we'll make a decision whether or not this makes sense. So this is going to be less about, again, cash in and percentage ownership. This is going to be much more of a traditional valuation model where we size the market and look at risks. Okay, ready to go? Thumbs up? All right. So as I said before, we're going to make an investment here today. And we're going to make an exit out here. And we're going to look at those 2 points. Notice we are ignoring all the points in between and all the points after. We really are just focused on 2 time points. And this is a major constraint to the model. Very often people say, well, how do I choose that time point? Well, it's an expectation. What does your business model usually do? How long do you let companies sort of grow and build up before you're looking for an exit? How long can you add value for? So we're going to look at those 2 points. Now, how are we going to determine the exit value? We're going to look at 4 things. Number 1, we're going to take a look to see how large we believe the total market is. Let's go back to our 2 ed tech examples. Let's say in example number 1, we're going to sell our product to school districts. That was our goal book. Let's say in example number 2, we're going to sell our product to teachers on a recurring revenue basis with a monthly charge. Everybody see the difference? What might we look at for the first one with goal book? What kind of data might we collect? We're going to sell our product to school districts that allow us to, work with the school district in order to help them with their special education needs. And the second one, we're going to sell directly to the teachers. What kind of numbers are we going to look at? Any ideas? Carlos, what are we going to look at for the first one? Just do the first one, Carlos.
total school district annual budgets, perhaps, to see what's the maximum consumption?
Yeah, I mean, Carlos, it's a great place to start, right? How many school districts are there? And how much do they spend each year on technology? Wouldn't you agree, Carlos, that'd be a good starting point? And then we can start asking ourselves questions like, well, how many school districts do we think we're going to penetrate per year? How many school districts do we think we're going to have within 5 years, which is our investment window? So there might be 60,000 US school districts, and we think we can do 20 school districts in the first year, and we think we can get up to 1,000 school districts by year 5. So we can start to think about how large the market is today and how much it's likely to go. Carlos, give me the second one. So the second one was Learn Zillion, and this time we're not selling to school districts, we're selling to teachers, and we're doing a monthly subscription. So what kind of data can we collect there to get a better idea for how large this market's going to be?
I mean, disposable budget for every teacher, but that's incredibly hard to calculate.
It is. All this stuff is hard to calculate, but hey, I'd like to know how many teachers there are in the country. Are there 1 million teachers? Are there 3 million teachers? And how much do they typically spend on the classroom? Right? Again, I might not be able to get my hands on this data, Carlos, but this is what I'm looking for. Right? How many school districts are? How much is their technology budgets? How many teachers are there? How much do they spend on their classroom? This will at least give me an idea of how large the market can be. And now the question is, how much can we capture in 5 years? Does that make sense to folks? The next question, how crowded is the space? So once we know there's this many teachers, how many companies are out there vying for their attention? Is it just us? Are there 2 likely competitors? Are there 5? Who's going to capture how much share and expectation? Maybe we don't really have an idea of who's going to win, so we just split it across the different players. Maybe one player is stronger than another, so we give that player 50%. Again, we're just using benchmarks, we're using data, we're trying to use judgment in order to come up with a value. Then we talk to the bankers. And we look at past transactions. Whoops. I skipped a step, I apologize. What we want to look at now is profitability. The third step is how do we convert revenue into profits? And again, for this, we're going to take a look at benchmarking. Some industries have an operating margin of 10%. Other industries have an operating margin of 60%. Which industry is this? Right? It matters. Is this an electric car company? Is this a software company? Is this a biotech company? Part of this will have to do with how crowded the space is, but a lot of it has to do with the underlying characteristics of the industry. So what do your margins look like 5 years out, 7 years out? Not today. Today, you're probably not profitable. But in the future, when you get to some kind of steady state, what does profitability look like? And then finally, the last piece, this is when we talk to the bankers. And we ask them about precedent transactions. If I have a market size, and I have an opinion on how much of that market I'm going to capture, and I have an opinion on how much of that revenue is going to translate to profitability, I can now take a look at a comps table. My banker says, here are the 8 transactions that have occurred with strategic buyers in the last 3 years. And this is the multiple of earnings, the multiple of revenue that these companies have traded at. So what I'm doing is I'm pretending like I'm doing this transaction. I'm putting money in today, I'm going to liquidate it in 5 years. How much revenue am I going to have at that time point? How much of that revenue is going to convert to profit? And what are people going to be willing to pay for that revenue or that profit? Talk to the bankers. All right. What I would like you to do is this. I'd like you to tell me what you think the exit valuation is in year 5 for this particular company. You believe the total market is 240 million. You believe there are 3 competitors. You believe that companies average 20%. And finally, the last thing is you believe that multiple of earnings is 12 times. See if you can run the numbers, and then I'll call on someone.
I have one quick question, David. When you say talk to the bankers, like, do you really mean talking to bankers, or is just like checking online, getting the data, and then doing?
You know, too much of this information is private that I'm not going to be able to get very much good stuff online. But the good news is, if I really am a venture capitalist, I'm doing enough transactions myself that I have a handful of good banking relationships, and the bankers are always desperate to talk to you. I mean, they want their own pipeline, and so they would talk to you daily if they could. So I'm a big fan of talking to them because they're going to have access to data I don't have, right? Okay, they're going to see transactions that aren't in the public domain, and they might not even be able to release those to me, but they can say, David, here are 7 disguised transactions that occurred over the last 9 months. Here's how much people paid. Here's how much revenue these companies had. Here's how many employees they had. Here's how much profitability they had. Because I want to get any kind of feel for what kind of pricing is happening in this market. And I can't just rely on the web for this.
And I can also leverage like other VCs, right? Like, let's say I'm a small fund, and then I can just like strengthen relationship with growth funds and get data from them. Would be the same strategy.
I'm going to try and get data anywhere I can.
Okay.
Right. And I have to admit, I worked for a top tier firm, so it was a little easier for me. But if I felt badly about this because I didn't realize my power. But if I called on a Friday night at 3 o'clock and I said, hey, I'm looking at doing a transaction in the ed tech sector, can you guys put together a couple pages for me on like what pricing looks like in ed tech? I'll get a 12-page pitch deck with a 40-page appendix by Monday morning sitting on my desk. Wow. And it was only later that I realized there was some poor 23-year-old who spent the entire weekend crunching the data for my whim. So I started to use my power a little bit more carefully, Bob.
That's amazing. Yeah, that's a dream. Thank you.
Can someone step me through it? Payman, did you do it?
Can I try it, David?
Yeah. You want to tell me how you ran the math?
Yeah, actually, the way I do actually is total market was 240, and there are 3 competitors, including the portfolio companies. So it means 3 companies is doing in this business. So we assume equal share. So revenue-wise will be about 80 million. And then
let me write it down. So 1/3 share for each of our companies. Here's the total market.
Right.
And so 80 million is our expected revenue, is the company revenue.
And then when you're talking for the EBITDA of 20%, so it means the EBITDA is 16 million.
So 20% margin.
Right.
So we believe that there's going to be a $16 million profit.
Right. And then you multiply by the 12 as an EBITDA based on the information from the bank. So we become 192.
So 12 times, and this is the multiple?
Yep.
And 16 times 12 is what?
192. 192.
All right. So we believe that this company will liquidate for 192 million. This is an intrinsic value, right? This is what we believe the company is worth at that point in time. And it's based on how large we think the market is. It's based on how crowded we think the space is. It's based on what we think industry characteristics on profitability look like. And it's based on what we think people will pay in the sector for a transaction like this. And this now gives us a $192 million valuation. Chris, can I start putting ranges on these things?
Sure. Yeah, right? Because actually it's, yeah.
Go on.
Yeah, because actually like there are so many judgments here, especially for number 1 and number 3. So in this case, then because of this judgment, you know, as a VC, then I have to discount these intrinsic values. Okay, well, the question actually is how much discount that I need to put.
Well, that's what we're going to do next. That's what we'll do. In a moment, we'll do that as well. But the point is,
Right.
I just wanted to make everybody aware that Chris is right. You know, that there's a lot of judgment here, guys. I mean,
Yeah.
it just is what it is. I mean, we're trying to project the future here for a lot of uncertainty, and we haven't even determined if the company really has a value proposition. I mean, 50%
Exactly.
of these transactions fail. So we're going to do our best to put some numbers around this. And that's why I think comparison is so important, because we can
Right.
start asking, you know, tough questions. Which of these two markets is larger, Goldbook or LearnZillion? Which of these two markets is more crowded, Goldbook or LearnZillion? Which of these two markets is likely to have a better margin, Goldbook or LearnZillion? Why? Which of these two markets is going to trade at a higher multiple? Right? We can start asking questions about comparison that I think are so much more relevant than trying to guess at absolute numbers. Any questions so far? Is the entire 192 million ours? So I make an investment in this company, Aaron. Is the entire thing ours?
No.
How much is ours?
No.
Just whatever we're left with in terms of a share after all the rounds of funding.
Yeah, absolutely. So let's take a look at that next. So step number 2 in our little 4-step VC model is, once we have an understanding of what we think the value is going to be in 5 years, we need to think about how much is going to be left over. For this, again, I look at the data. I try and get as much data in all of these conversations as I possibly can. I'm not going to let the data rule the day. I'm still going to use a tremendous amount of judgment, but the more context I can build, the better judgment I'll have. So here's some data on how much is given away. This is a bias sample, so be careful. This is the Wilson Sonsini data. They put out something called the Entrepreneurs Report quite a bit. All the major law firms in Silicon Valley do it. They put together these reports once a quarter with the various transactions. How many up rounds are there? How many down rounds are there? What does pricing look like? How much is being given away? I have all of them coming into my inbox, because again, the more data I have about what the market is currently doing, the smarter decision making I'm going to be. This happens to be from Wilson Sonsini, which is a very well-known firm in Silicon Valley. Here's what the numbers look like on the left. 20% is given away in the seed stage, 23% in Series A, 12% in Series B, and then Series C and later is hard to interpret because those could be Series E, F, G funds. You just don't know. They're all lumped together. How much capital is raised? Well, again, remember, this is based on success here. If the capital is not raised, the company doesn't make the data sample. So 2, 6, 10, and 20 million. So this is how much capital is raised. Why is that important? Because we have to think about, if our company is successful, what's that going to look like? How much capital will it need based on our cash flow plans? How many people will it hire? How much R&D will it do? We have to have some kind of perspective on cash. All right, so let's say that today, this is the transaction on the table. 25% of the company for 5 million. That's what the founder has put on the table for us to consider. The problem is they're going to need a Series A round after this, and they're going to need a Series B round after this, because they're going to need another at least 15 million over the next 5 years to get to sale. So to get to exit. That means you're going to start with 25%. And then you're going to have a Series A. You're going to have a Series B. And so the question is, what's left over? See if you can do it based on these two numbers. How do we use the 23%? How do we use the 12% to think about what our ownership stake is going to be if we make an investment today to take a quarter of the firm, but have to do a Series A and a Series B round to get to the final outcome? See if you can do it. Alex, do you have it?
I believe so. So the first round would lead to 19.1.
And how do you know it's 19.1? What do you do to get there?
Well, I multiply the 25% by 0.766.
So 1 minus 0.234, is that what you did?
That's easier. Thanks.
And what did that give you one more time?
19.1.
So 19.1%.
And same equation, just with different numbers, like 1 minus, so multiply by 1 minus 12.3%, and that leads to 16.75%.
16.8. So Alex, what's happening to our ownership stake over time every time we raise capital?
It dilutes.
Everybody see that?
We don't co-invest, right? So we could also choose to invest equally, then our stake would remain the same.
It would, Alex, but we're going to treat that different, because what we're really doing right now is we're not valuing the total ownership stake eventually by the company. What we're valuing is this particular share. Does that make sense? So
Yeah.
even if we're the ones that re-up, this share that we're valuing right now, this stock is going to lose its percentage ownership. So there is a difference between the two. But I agree with you. Our total ownership stake may be different than what this particular stock is worth. So that's a good point. What if we don't need to raise any capital? What if the company is instantly profitable?
Then it stays at 25?
Yeah, I mean, if we can't get good transactions that we really, are happy about, we won't raise any capital. I mean, one of the reasons why some founders have 80, 90% of their companies and some venture capitals are extremely wealthy is because the company was profitable immediately. It was basically generating enough cash to fund its growth. It didn't need more capital. And so the original investors kept their ownership stakes quite healthy. So there's going to be a big difference between a company blowing through cash, right, and a company that's generating cash. And that's why I love founders who think in dilution, right? So, that founder who wants to run the $1 million Super Bowl ad doesn't think of it as $1 million, but thinks of it instead as 5% of their firm in the next round, right? Because it keeps them a lot more honest, when they're thinking about those expenses as future dilution of, stakes that they're going to have versus, oh, it's just $1 million of money we've already raised. No, that money is going to have to be replaced, to continue the growth. And so we're going to want to think through exactly how much each thing costs. Any questions about step number 2? So step number 1, size the market, figure out what the transaction's worth. Step number 2, think about how much we're going to have left over. Any questions? All right, let's continue on. Here comes the toughest part of all. Step number 3. What do we discount that? So now we've got this number in the future, 192 million. We believe we're going to own 16% of it based on the additional capital we need to raise. What do we discount that? Well, in option number 1, call this a traditional valuation, we use the cost of capital. What is the cost of capital? The cost of capital is a risk-adjusted number of what we think other securities will earn with similar risk. It's what we're expected to earn on other securities. That's not what we're going to do here. In VC valuation, we're going to do something else. We're going to use something that people call a target return. And as you're going to see, it's going to be much higher than the cost of capital. And we'll talk about the 2 numbers. Why? Because what we're going to do is we're going to incorporate the probability of failure into the cost of capital. And that probability of failure, when it's high, is going to make the cost of capital seem very big. But before we do that, let's play a little bit with this idea of what the heck a cost of capital even is and how does it differ from a target return. So imagine for a moment you're evaluating a late stage startup which has a very high probability of success. It's already, a Series G, and so this company is real and it's going to get to an exit. If successful, the company is going to exit for $10 million in 1 year. But if it fails, you're only going to get 4 million. Okay, so if it fails, all you get is 4 million because you're going to sell the assets off for a much lower value. What I would like you to do is I'd like you to do what's called expected value. When we do an expected value, we take the probability weighted cash flows and we discount them at the cost of capital. Let's say that right now our cost of capital is 10%. What I'd like you to calculate for me is what the valuation of this security is today using good old-fashioned traditional finance. This is traditional finance, nothing to do with venture capital, scenario-based valuation. See if you can do it. How much is it worth today based on probability-weighted cash flows at the cost of capital of 10%? Take just a moment, and then we'll do it together. Leonardo, when you have an answer, you want to step me through it? Do you think you can do it, Leonardo?
Let's see. So I computed a 0.8 multiplied by 10.
Yep.
Plus 0.2 multiplied by 4. Everything divided by 1 plus the 10%, which is 1.1.
And what's our valuation equal to?
Well, if I do the math right, it should be around 8.
Is it 8.0?
Yeah.
This is old-fashioned finance. And I say old-fashioned, I shouldn't be saying that because it's still modern finance today. But this is like traditional finance. Probability-weighted scenarios discounted at the cost of capital, which in this case is 10%. And that cost of capital is based on things like the CAPM or the Fama-French models. It's just a straightforward valuation. Everybody with me so far? We'll talk about then what venture looks like. All right, let me show you one more thing about traditional valuation. What I'd like you to compute for me is what is the expected return. So as an example, if the company earns 10 million, but you pay 8, what's your return in the upstate? What's your return in the downstate? What is your expected return, your probability weighted return? See if you can come up with that number. There's a nice learning here if you haven't seen it before. What is your expected return? And Leonardo, I'll let you continue on. If you get some of these numbers for me, let me know.
If someone is faster than me, just go ahead.
It's okay. Anyone have it? Can anyone give me the return in the upstate? If this is successful, what will the return on our investment be? We put 8 million in, we get 10 million out. Alex, what'd you come up with?
25%.
And what about in the downstate, Alex? How much do we lose there?
A lot.
We lose a lot, but I need the exact numbers. Anyone have them?
It's minus 50%.
It is. So we lose half our wealth, right? We get hammered. So in the upstate, we make 25%. In the downstate, we get hammered. It doesn't look like this is a fair bet. Well, it is, right? Because there's a much bigger probability of the upstate than the downstate. So what's our expected return? Point what? 8 times 0.25. So 80% chance of making 25%. We have a 20% chance of making what? Minus 50?
Yep.
And so what's my expected return? .8 times 0.25 plus 0.2 times minus 0.50.
1.
It's not 1.
10%. 10%.
Our expected
10%.
return,
10%.
10%. Does that number look familiar to anybody?
Yep.
Yep.
Right? That number is your cost of capital. This is why we use the words expected return and cost of capital interchangeably. It's the expected return based on the risks that you're facing. This is the return that you're earning on this particular asset. It's the expected return, the probability weighted average return, upstates, downstates, wins, losses. This is what you're expected to earn. Does that make sense to folks? This is traditional finance. This is what we would teach in a CFA program or a corporate valuation program. This is traditional finance. All right, so what do venture capitalists do? Venture capitalists do not focus on expected return. They focus on the win. They focus on what if everything goes right? What if we are able to capture a $240 million market? What if we are able to protect a 33% share? What if we're able to earn a profitability of 20% and then sell this thing for 12 times our profit? That's success. So they model success. And then what they do is they discount, not at the expected return, but at what I like to call the success return. So as an example, what does that look like in this particular case? Well, what did success look like, guys? What did success look like? What was success? We sold the company for $10 million. That was success. Everybody agree? What was failure? We walked away for 4. We're not going to look at the 4. We're only going to look at the success. But when we discount the success scenario, we're not going to discount it at 10%. That cost of capital is way too low. We're going to discount it at the success rate of return. What's the success rate of return? It's on the screen. Anyone see it?
25.
It's the 25%.
25%.
That's the success rate of return. That's what you're supposed to earn in a successful scenario to break even. So if I take the 10 million and I divide by 1.25, what do I get? $10 million divided by 1.25, guys, what is it?
8.
I get the correct valuation.
8.
What venture capitalists do is they do not focus on the full realm. They focus mostly on the upside. What does success look like? But if you're only going to model success, then you can't use the cost of capital, because the cost of capital takes into account everything, success and failure. You can't use your weighted average cost of capital. You can't use your CAPM betas. You have to use what we call a success discount rate, what venture capitalists call the target discount rate. This 25% is a very high number, but it's going to be the number that gets us to the appropriate valuation. Now, this was a one-year example, wasn't very realistic. It was meant to sort of show you the difference between a 10% cost of capital and a 25% success rate. I'll show you a much more a realistic example on the next slide. But before I do that, any questions? I know this is getting overwhelming. There's a lot of numbers flying around now. Any big picture questions before we make this much more realistic?
David, I have a question. Looks like on these examples, the value using the conventional method, and then based on also with the VC target return, it end up about 8. Is there any magic on that, or it's just
no? But that's the way it's supposed to work, Chris. If we do it correctly, that's the way it's supposed to work. And by the way, Chris, I'm going to steal your word. I like your word a lot better than mine. Rather than even traditional, conventional, right? The top model is the conventional model that today's best trained hygienic finance people do. But what we're going to do is the bottom model, which only focuses on half the equation. And Chris, it can lead to problems, right? When we do that simplification, it can lead to problems. All right, so here's something much more realistic, guys. Take a look at my graph on the left. Notice I have 2 dimensions on slide 22. How many years is it going to take to get us to the exit? Again, this is an estimate. Is this a 3-year deal, a quick turnaround? Is this a really long window of 7 years, or is this the average window of 5? We're going to have to make an assumption, a forecast about this. Number 2, what's the probability of a positive exit? Is it 10%? Is it 30? Is it 90? Again, probably not going to get an exact number, but I'm going to have some kind of assessment on this. Imagine that success is $100 million. That if we exit, we're going to get $100 million. And if we fail, we get nothing. Imagine the appropriate expected rate of return for venture capital is 12.5%. That number is probably a little bit higher now, but where does this number come from? This was what venture earned between 1980 and about 2018 when I put this note together. So 12.5% is what all venture capital funds earned over about a 40-year period. So we'll treat that right now as our cost of capital. What I would like you to do is I would like you to use the conventional method to come up with a valuation today. So see if you can do it. What is the conventional valuation method that gets us to a valuation today? So if I have an exit of $100 million, failure gets me nothing. I have to walk away. My cost of capital is 12.5% for venture capital based on 40 years of data. And then Chris, I'm going to send them out to a team room for just a moment, if that's okay.
Yep, that sounds good.
Marcelo, do you have it? Any idea what that number is that belongs in that blue circle?
I did correctly, 16.65.
And where did you get that from, Marcelo? How did you do it? What were the numbers you put in your model?
But the success rate of 30% times 100 million.
The failure rate is 70%. And Marcelo, what are we getting in the failure?
Zero.
Nothing.
Right.
So we don't even really need that, but I like to put it there just as a professor.
Okay.
Again, not just because I'm being complete, but you don't have to do that clearly, right?
Okay.
If it's zero. And what are we discounting this by?
And then I get the present value for that. It's 1.12.125.
To what power?
3 times 5, right?
To the 5th power. So that's meant to be a power there. If it's not clear, 1.125.
It's 1.8020. If I'm not.
And this gave you 16.7.
Yeah.
Success is awesome. $100 million is a lot of money. Yet it's only worth 16.7. Marcelo, why is it worth so little? $100 million payoff, and yet it's not worth very much. Why not?
Because of, success rate is too low, right?
Yeah, everyone see that? I mean, the probability of failure is awfully high. There's only a 30% chance we're going to be successful. And so therefore the valuation is incredibly low. Everybody see that?
Yep.
It would be even lower if what happened, Marcelo? Imagine we went down to a 10% success rate. How much is it worth now?
5.5.
Everybody see that? So this table, what it does is it just builds exactly what Marcelo did in Excel. If you give me a window and you give me a probability of success at a 12.5% discount rate, this is what the opportunity is worth. Okay, so what do we do next? Here's the final piece. This is my target multiple. I can do it as a target return or a target multiple. My 16.6 is going to become $100 million if everything goes well. So what is the multiple that I need to earn to grow 16.6 into 100? How many times do I have to earn on that 16.6? So Marcelo, can you run that number for me quickly? What is 100 million divided by 16.6?
Six. 6.02.
6.0 times. For me to earn a fair rate of return on my investments, I have to earn 6 times what I put in. If I believe the probability of failure is 70%, if I believe my money is going to be tied up for 5 years, I have to earn 6 times my money for this to be a decent deal. So a lot of people, what they'll do is they'll do what's called a target multiple. This is an example of the target multiple. Marcelo, what if this is a real long shot? What if there's only a 10% chance of success? What does this table tell me I need to earn on my money in order to meet expectations?
18 times, right?
Everybody see that? If I'm going to tie up my money for 5
almost
years,
300 million.
With only a 10% rate of return, whatever I put in, I'm going to have to earn 18 times my money to break even. That's what success needs to look like. Success can't be doubling my money. Success can't be tripling my money. I have to believe that if this company is successful, I'm going to earn 18 times my money if there's only a 10% rate of return, 10% chance of success. So what the target multiple does is it tells me what the upstate needs to look like. So that's what we're going to look on. That's what we're going to focus on. Not an expected return, but on success. What does the success model need to look like for me to break even? 6 times is the number we're going to focus on. All right. Chris, this is where I'd like to send them out to a breakout room. Guys, this is what I would like you to do in the breakout room. I'd like you to do it one more time, but this time I want you to think about what the rate of return needs to be per year in order for me to break even from a discounted cash flow perspective. On the previous page, we did multiples of money. Now I want you to think about what the annual rate of return needs to be. I also want you to spend a minute or two just reviewing what we've covered with your team. I want you to be able to say to your 2 to 3 teammates, I have no idea what he's talking about. Help me understand what the heck is he doing. I'm hoping with leaders teaching leaders, maybe you can explain it in a way that I didn't do a very good job of. And so if you can say, well, this is what he's doing on this slide, and this is what he's doing here, and this is what we need to do now. Why are we doing what we are doing? And why are we focused on success instead of expectations? What you need to fill in, since I've already done this number for you, is you need to fill in this number here. Again, what does it take for 16.6 million to grow into 100? But this time I'm asking you for what the IRR percent is. Okay? All right, Chris, let's give them just a couple minutes in the team rooms. We'll come back and we'll discuss it.
Opening our rooms now.
Thanks, Alan. Head on out, guys. Quick discussion. We'll bring you back in just a minute.
Please click Join Breakout Room to enter your breakout.
Alan, you should also have the option to move manually as well. You just highlight the name and you go to move to if needed.
Oh, you can manually move people? I didn't know that.
Yeah, if you just hover over their name now, you'll see move to beside them.
I think only the host can do it, right?
Yeah.
I think co-host can do it now as well.
Let me see.
Well, the good news is everyone can
it says put in waiting room.
Yeah, we can change your room, but we can't send you there.
Yeah.
Yeah, I don't see it.
Alan might be able to do it. I don't know.
Right, I'm going to try and see. No, it's not giving me the option to move to room 4.
Yeah, I can move people around and assign them to a room, but I can't send them to their room.
Something, Alan, I'm okay with that. I like it better when they have the opportunity to go, because sometimes they want to stick around and talk to me.
Yep.
The only thing I do like to do is force them back into the room. Obviously, they would stay there forever if we didn't bring them back. And Alan, what's the timer you have on the breakouts? Is it 2-minute countdown?
Yeah, so I changed it to 2 minutes.
Thank you. I appreciate that. So I'm going to give them another minute because we're going to send them right back out to the same teams, if that's okay.
Yeah,
on slide 24.
Sounds good.
So much work to do. All right, let's give them the 2-minute warning, Alan. I mean, let's close the rooms. Perfect, thanks.
You're welcome.
Welcome back, folks. We're just waiting for folks to come back. Mark, will you be able to do it for us?
Look, I didn't calculate it myself, but I'll give it a try.
Okay, let's wait for folks to come back, and Mark will give it the best shot. We'll work on it together. But I got 30 seconds before folks come back. Welcome back, folks. We're just waiting for teams to come back. All right, Mark, so I want you to answer 2 questions for me. Question number 1 is, how do I solve for the rate of return? And question number 2 is, why are we doing this? Right? We don't know why we're even doing it. We're sort of wasting our time. So let's start with just the math first. At what rate of return do I need to grow in order to get to the 100 million? Did you come up with a value?
Look, we came up with a value, but I didn't calculate it myself. But conceptually, we say we're going to solve for 100 million, and the probability, and we want to have 16 million in the end. So, look, I kind of get it, but I couldn't calculate it myself immediately.
So did anyone from your group know how to do it?
Sean,
Roberto, Carlos, any ideas what we do? Sean? Yeah, Sean, jump in.
So I just did 100 million future value, 16.7 present, 5 years, and then solved for the rate, which was 43%.
Okay, hold on one second. So 16.6 times 1 plus R to what power?
5.
And that equals how much?
So I actually cheated a little bit because I just used my financial calculator, so I didn't actually break it down by step.
Lucky man. And you can use, if you want to use a financial calculator, it's totally fine. But there's what the equation looks like, right? 16.6 times 1 plus R to the 5th equals 100 million. Everybody see that? We're trying to figure out what rate of return we will earn if we have a success. We put 16 million in, we get 100 million out. This is what we did before. Before we said we put 8 million in, we get 10 million out. We're doing the same thing. And Sean, when you solve with your financial calculator, which does the right thing, you got R equals what?
43%.
43%. So what does this 43% even mean, Sean? And how are we going to use it?
It's the annual, it's basically the compound annual growth rate that ties 6.6 to 100 over 5 years.
Exactly. But let's think about what it really means. This is the rate of return I need to earn in a success to break even. If I don't earn 6 times my money in success, I won't break even. If I don't earn 43% a year in success, I won't break even. Can anyone tell me why this number is so high? I mean, 43% annual return is ridiculous. That's a massive. Why does it need to be so high, Sean?
Because it assumes our cost of capital, our opportunity cost is so high for our funds.
No, our cost of capital is only 12%. Raphael?
The failure?
One of 10 times, three out of 10 times you get success. 7 out of 10 you're screwed.
Yeah, everybody see that? So our return 30% of the time is to make 6 times our money. 30% of the time, we're going to make 6 times our money. 30% of the time, we're going to have an annual return of 40% a year. 70% of the time, what's our return going to be? Don't say 0. If it were 0, we'd be fine. It's not going to be 0. 70% of our time, what's our return going to be? Not 0.
Negative.
Negative 100%. 0 is break even for a return. We're going to lose everything. We're going to put in 10 million bucks and get nothing back. We're going to have a minus 100% return. We need to earn 6 times our money to break even. That's what this is saying. So the way you do the venture capital model is like this. Step number 1, use the 4 data points to come up with an exit value. How large is the market? How much are we going to capture? What the comps table tells us. Come up with an exit valuation. Step number 2, think about how much we're going to have left over after we raise additional capital because we need more cash. Step number 3, take that number, which is a success number. Don't discount it at 12.5%. 12.5% is way too low. Discount it at what? The success rate of return, which in this particular case is how much? 44%. This is taking into account the fact that most likely you're going to lose all your money. If we're going to have this be success, how large does success need to be in order to cover the losses? That's what we're asking. And this will then give you a valuation that's consistent with DCF. Okay? All right. I'm going to send you back out to the same team rooms. And this is what I'd like you to do. On slide 24, I'd like you to take all of these steps with your team and put them together. And please, leaders teaching leaders, some of you who don't use mathematics every day, who don't practice valuation very often, this is really challenging stuff. For others of you who do this every day, it's relatively straightforward because it's actually simpler than what you're normally used to doing. Steps 1 and 2, how large is our valuation? What percentage did we get to keep? Step number 3, discount it back at the success rate of return. Step number 4, company is demanding $5 million and they're willing to give you 25% of the company. Purely based on the mathematics. Should we do the deal? Does the deal make sense? See if you can think about this with your team and then we'll go through the math together. This is the slide that puts everything together. All the numbers from our last 7 or 8 slides all go here on slide 24. This is the recap slide. Everybody got that? Same data we've been working with all lecture note long. What's the value of Starco? Sean?
Yeah. So when you say this is how big of a success does it have to be to cover all of our losses? But it's almost, it's how big of a success, and I just want to clarify, it's how big of a success does it have to be to cover all of our losses and still get back to that cost of capital? Or,
Yeah, this is, Sean, this is just a break even. This just
Right.
says we're going to earn our cost of capital.
Right. Okay. Yeah.
But notice how large the wins have to be. I mean,
Yeah.
you have to make 6 times your money in 5 years in order to earn your 12.5% at this failure rate.
Yeah.
And this failure rate is pretty typical, right? A 60-70% failure rate is what we see in VC. Imagine you were doing some crazy stuff where you had 90% failure rates. That means your wins have to be really large. You can't just go in there and sort of double your money. You've got to like think about an investment that's going to make 20 times your money to cover a 90% failure rate. Okay. All right, let's send them on out. Slide 24, see if you can complete it. Have a conversation with your team. We'll bring you back.
Opening all rooms now.
Hi, Alan. I had a quick question. Can we access the slide deck on Canvas?
Hi, Satish. Yes, you can. So today's deck is a continuation from Wednesday, but it is posted on today's day.
Oh, okay. Okay. Thank you.
My pleasure.
So Chris and Alan, I'm going to make a suggestion, which I'm sure will break the bank.
Sure.
99% of programs, it makes sense to do it by the day because we have a different faculty member every day. So why would you ever organize it by faculty? For a program where we only have 4 faculty members and we're always coming back to our original material, it probably makes sense to do the organization by faculty member and not by day. I don't even know if that's possible because I know Kevin uses the same deck. I use my similar deck and materials and go back to it. And so if you just sort of said it's under David or it's under Kevin, rather than doing it every day, it might be a much better idea.
Yeah.
Yeah, absolutely.
Yeah, that's a good idea.
Just for this program, 90%
Yeah, not
of
for all
programs,
programs,
like
yeah.
AMP would make no sense because you're seeing a new faculty member each day. And so it makes sense to organize, okay, guys, it's Tuesday, this is your day. But since
Yeah.
we're always coming back to the same faculty members multiple times, and a lot of our material is building,
Yeah, it makes sense.
at least while we're online. I don't know how much longer we're going to be online for, but with the rate of vaccine, it looks like the answer is for a little while at least.
Yeah. Yeah, I don't know.
So something to think about, guys.
Yeah, thanks, David. That's a good idea.
All right, Alan, let's give him the 2-minute warning.
Okay, sounds good.
I keep saying that, but let's close the rooms.
Yep, closing.
That's what I mean when I say the 2-minute warning. Some people take me literally and they put out a 2-minute warning.
Yep, I understand.
So. And I see we're losing a little bit of the video connection from our teams. We're losing the culture guys. I don't know if we need to remind them, but we started off on full screens and now I've got only about a third of the group that are coming on video.
Yeah, I noticed that too. As they're coming back, I'll remind them to please unmute their video.
Yeah, we'll take a break after we do this
Okay.
presentation. We both can remind them. You just
Okay.
set up a reminder.
Yeah.
Because I
that's
know,
fine.
you know, it just will keep getting worse and worse until there's only a handful of people.
Right.
I know that
right.
won't make it fun for
Just
Kevin
see,
either.
like other people doing it, they'll think it's okay for them to do it. So.
Exactly.
Hi, everyone. As you come back, please remember to unmute your video just so we can see you. It enhances the culture of our classroom. So if you could do that, that would be great. Thank you.
I was going to call on Patrick. Patrick, you're there. Good. Patrick, any idea what we do here? How we start on the right-hand side and work our way back to the left? Did you get any?
We do, but I'd like to call on one of my colleagues here, Raphael, that did this during the thing. He was one of the leaders who was explaining this to the others, and I think he.
All right, but Raphael, move slowly so we can follow what you're doing. I'm looking for where you're at. There you are. Okay.
Hi, let me unmute myself here. And well, do you mind, Professor, if you go back to slide 17 and go through all the process?
Yeah, I'd be happy to. So I'm starting on the right-hand side of that slide, and that right-hand side requires the work of 17, right?
Yes, there you go. Well, considering that we have agreed upon the valuation of, if everything goes right with the project, of $192 million as an exit 5 years from now, right?
Yep. And so, Raphael, take a break for 1 second. I want everybody to realize this is what we mean by a success scenario. This isn't about the company failing and closing up shop, and that's probably what's going to happen, right? This is about, hey, if everything goes well, we're going to capture a $240 million market. We're going to capture a 1/3 market share. We're going to make money with profit margins, and we're going to sell this thing for a healthy multiple. And that gave us how much, Raphael?
$192 million.
192. But do we own the 192, Raphael?
No, sir.
No, we do not. So 192 is the exit valuation. And now the question, I'm on slide 24. How much of it do we get to keep, Raphael?
Well, considering that we have invested $5 million for a fully diluted ownership of 25% at seed stage, and that we have gone through further 2 dilutions that are on slide 18, one dilution to 19.15% and a second dilution to a 16.8% stake. That is on
we lost almost 10%.
On the bottom top right corner.
Yep. We lost almost 10% of our company because we had to raise additional capital. And we brought capital in. It's not like we didn't get anything for it. We brought 16 million of cash in, but that cash is going to be burned through, according to our forecast, over the next 5 years. So if I take that 192 times how much?
Times 16.8
What's our stake in 5 years?
is 32.25.
So we believe that our stake, if things go according to plan, if things go well, that someone's going to write us a check for $32 million. That's the
There you
money
go.
we're going to see in our pocket in 5 years. But we don't need the money in 5 years, Raphael. We need to know how much it's worth today. So what are we going to discount it by?
Well, if we discount by the successful rate of return of 43.2.
1.432 to the 5th power.
There we go.
And what's that equal to today?
Just a minute, because we did the other. As a matter of fact, we did the other way around, but it equals to 5.35.
5.4 million.
Yeah, we did in the other way around in the sense that we calculated the exit multiple, money over money, that is 6.45.
Yeah.
And consider that our expected return is 6 times of for an exit. We thought, well, that's a good deal, because it implies a IRR of 45.2 instead of our cost of capital of success.
Yeah, but this is not the way.
Yeah,
but we can't think about it like this, guys. We can't look at this deal and say, oh, it earns 43%. Let's do it. There's a 70% chance of failure. What we need to do is the model we just did here, 32.3, and we can either do one of two things. Either we can discount it at 43% a year. That's our target cost of capital. Or we can divide by 6. Why am I dividing by 6? Same thing. That's our target multiple we need to earn. Now, if we do that, that means it's worth 5.4 million. And to buy this ownership stake, how much are we spending?
5.
So the question is this: on a pure NPV basis, based on 5.4 and based on 5, is this a good deal? Sean, what are you saying?
I'm saying yes, because it creates a positive NPV above our 5 million.
The answer is yes. He's right. But let's be careful here. We are creating 400,000 in NPV. Agreed, Sean?
Yep.
Okay. There are two things I want you to think about. Question number 1, is this good enough? We only have so many bullets in the gun, right, Sean? I mean, I've got a fund here. I can only make 20 investments. Is $400,000 of NPV enough, right, based on where I am in my fund's life?
Can I ask a quick question?
Sure.
And I think this is just getting you back to just how narrow the spread is here. So what we did, and I actually did it wrong because I used 100 million. I was using that $100 million success.
Yeah, that was a different example. I was just trying to keep it simple.
Yeah, but if we do the 192 and then it gets us to 32.3.
Yep.
And then I just come back up with the IRR that goes back to our 5 million. It kind of creates the same question, which is then we go back to a 45% return instead of 43, and it's like, is that extra 2% really make it worth it?
Yeah, and that's the question we have to ask. I mean, it's a legitimate question, Sean. Yeah. In a pure theoretical world, we take this deal. Is that clear?
Mm-hmm.
In a pure theory word, 45 is bigger than 43, we take it. Yeah. We have to ask ourselves, what does the window look like? I have 20 bullets in the gun that I'm going to shoot over the next 5 years, over the next 3 years. Is this deal good enough to waste one of my bullets?
Probably not, because we're relying too much on our assumptions, the 70-30, right?
Perhaps. Sean, I think at the end of the day, this is going to be a judgment call based on the quality of the deals we're seeing coming in. If this is the best deal we've seen come in the first 2 years, of our investment window, we might want to take it. Because 2% isn't a lot, but if it's the best we've seen, maybe this is what we're going to earn. Or maybe we want to wait. This is where the judgment is. And a lot of it depends on how many deals are coming across our pipeline and how good those deals are. If this is one of the better deals we're going to see, maybe we pull the trigger. But this is where the judgment is. But from your pure NPV perspective, this is a good deal. Here's catch number 2, Sean. You ready for catch number 2? We haven't computed fees and carry. Dun, dun, dun. This is a pure gross number, right? We've got fees and carry. So we've got to somehow, we won't do it today. I'll give you some reading material on it. But we've got to think about how to incorporate fees and carry because our limited partners, they have to pay us. And if this is the best we can do before fees and carry, I can only imagine how bad the number is going to look after fees and carry. So we could rerun these numbers thinking about, all right, if we give 20% of the company to the LP, excuse me, to the GP, and we also take a 2% annual fee, what kind of rate of return do we need to earn on top of this NPV in order to pay fees and carry? So just keep these two things in mind. Bullets in the gun and fees and carry. Okay.
Professor,
Yeah.
I have a question.
Sure, Chris.
Actually, yeah, I have a question that when you the value of 5.4, that is the present value of the whole company. Is that correct?
No, it's the present value of our stake.
Oh, your stake.
And it's not the present value of future stakes. If we buy in the Series B or Series D, that doesn't incorporate this. This is just what the security is worth. We're about to buy a security for $5 million, and it has a present value of 5.4 based on this model.
And also, can you explain again for where is the 0.6168 come from when you multiply by 192?
Yeah, great question. The 0.168 came from slide 18. It's right here. At the bottom of slide 18.
Oh, I see.
If you remember, we bought 25% of the company, but we had to give away 6% in our Series A round to get another 6 million. We had to give away another 3% to get another 10.3. And you might say, well, but this is only if the company's successful. That's right, because what we're doing is we're doing a success model, and then we're discounting it at a success rate of return. And that present value is worth 5.4. And my main point right now that I'm asking you guys, you know, is 400,000 in NPV enough to compensate us for fees and carry? Is it enough to compensate us for the fact that we have limited shots on goal?
Yeah. Thank you.
Other questions, comments from the group?
One general comment is that, I mean, I know that we're doing a theoretical exercise, but in theory, there could be debt-like liabilities. So you have to take the net debt, if there is anything, off of the 192. Yeah.
Agreed. And I'll say this. Anytime we feel restricted by this model, is it Jose or Jose?
Jose. Sorry.
Jose. Okay. I didn't know what part of the world you're from, and it matters, right? So, Jose, you know, yes, I agree with you. It could be more complex than we're making it. The more complex it becomes, the more we have to move to traditional discounted cash flow. Traditional DCF gives us more flexibility. And anytime we feel restricted by this model, we've got to move closer and closer to a traditional enterprise value multiple. But the good news is, for most VC startups, for the goal books of the world, for the Learn Zillions of the world, this is probably the most complicated we can get. Because remember, Goalbook and Learn Zillion, when making this investment, didn't even have a good idea of what their revenue model was going to look like, right? So doing a very complex discounted cash flow model doesn't make a lot of sense. In fact, even if you feel like this model was overwhelming to you because it was too technical, just think about what questions you would need to ask to get a handle on these numbers. And that's what I have on slide 25. Right? Even if we're just talking about these things qualitatively instead of quantitatively, we can ask questions that make sense. Agreed? I like these questions on slide 25. Question number 1, how large do we expect the market to be? Question number 2, how much of the end market will we capture, i.e. how crowded is the space? Number 3, how profitable do we think the company will be? Question number 4, how much do investors pay for successful companies? Question number 5, what do we believe the probability of success are? These were all the data inputs we needed for our model. Question number 6, how long is it going to take to get there? 3 years, 5 years, 7 years? Question number 7, how much additional funding is required to get to that endpoint? And question number 8, how risky is the company and what's the expected rate of return for an investment of similar risk? That's the cost of capital. So these are the 8 inputs that go into our model. And I think these are decent inputs to be thinking about. If you have no perspective on how large the market's going to be, then you don't know the value. If you have no perspective on how profitable you think companies in the space can be, then you don't know what the value is going to be. If you don't know how much of the company you're going to have to give away, again, you won't know the value. And if you don't feel comfortable with these 8 questions, go back to the sweet spot. How much money are you putting in and what percentage of the company are you taking? Boom, you've got a valuation. So this would only be if you feel comfortable with these 8 questions. Make sense? Thoughts, concerns, questions?
I guess I'm just thinking through like the knock-on effects of like, I'm thinking about the incentives and the alignment of the incentives between both the investor and the entrepreneur. So if in this model takes into the effect that you're calculating the failure of your investments, but then like, how does that, what are the knock-on effects? What is the tension? Does that draw any tension with the relationship between the investor and the entrepreneur? So where the investor is looking to say, we want to see these kinds of returns, but at a seed stage company like that, there might be some conflict that is there with regards to the returns that the VC wants to find and the decisions that the entrepreneur needs to make in order to say, you know what, I think we should be going this route now. And it might mean not getting those returns, but it might mean setting the business up for success over the long run.
So Kristen, I have to think more about whether or not this particular model will drive certain behaviors. I need to give that some thought because I've always thought about this model as an analytical internal exercise. Okay.
Got it.
So I have to admit, I haven't given the frame that you've just put on it. And I think that's important. What I can tell you is this: it may be a shock to the founder because you as the investor know that 40% of these things are successful, that 60% fail. So therefore, when you put the numbers in your model, you need success to be 6, 8, 10 times the money you put in, which means the market needs to be this large or the market needs to be this profitable. And that could be so much bigger than the founder's expecting, right? You might go in there and say, look, for me to overcome the probability of failure, if this is going to be a success, I need you to have 1 million users by 3 years. If you don't have 1 million users by 3 years, success isn't large enough to pay for my failures. And that might be a shock to the founder who might just be thinking, well, let's just sort of see how this grows organically. Let's see how many teachers we get in the first year. Let's see how many teachers we get in the second. We get 30,000 teachers, we'll consider that a win. That's huge. And Kristen, you're sitting there, Kirsten, my eyesight's not good enough. I apologize because I already screwed this up once. The founder might not be ready for the fact that you're about to tell them, no, for me to make this investment, I need you to commit to 1 million teachers by 3 years.
Yeah.
That's how fast we're going to have to scale.
And I guess the first sort of like thing that I take from this is that it really encourages VCs to push for the expenditure of that capital. So you're basically, from an entrepreneur, you have to understand that VCs are expecting you to take their money and spend it as quickly as possible. And because they want to see if this is going to be successful or a failure as quickly as possible.
Yeah, that might be part of it as well. I don't know if I'd go that far. I don't know if I'd go that far, but I do understand what you're saying.
Yeah.
I do think there might be situations where we need to go a little bit more slowly, but you are right in that we're busy people and we need to figure out whether or not this value proposition works.
Cool. Thanks.
Aaron, did you want to, Leonardo, jump in?
Yeah, I mean, you're transferring a lot of the pressure coming from financial markets and the relationship you have with the LPs on the invested companies. I mean, the founders, have to deliver results that are not really tied to their industry and their market, but more to the interests of their investors, which is a bit different. I mean, you're selecting the companies based on the pressure that you have upstream, if you say like this.
I mean, one of the blessings I've had, Leonardo, about teaching this class for the last decade is I've had hundreds of founders come through my classes. And I have to tell you, they feel that they learned more in this class than any VC ever did, because it allowed them to understand the pressure that they would be under and the incentives that would be in place based on this relationship between LPs and GPs, based on probabilities of failure and how large markets need to be in order to overcome those failures. That they just didn't have an appreciation for these things. It allowed them to be better negotiators, but it also allowed them to level set a little bit more effectively up front with their people, their employees, and themselves. Alex?
Yes, thanks, Professor. I was going through the inputs of this calculation, and I think there's so many like rather easier things like market, well, not so easy, but market size and everything can be calculated. But how do you have like hints on a probability of failure? Because putting in 20 or 40% obviously
makes a big difference.
But are there any guidelines for that?
No, I don't think there are. What we can do is collect as much data as possible. So, I mean, we have 70,000 plus rounds of financings. And so we can look at industries, we can look at other characteristics, but I don't have access to those models, right? So we could look across industries, we could look at stage of the company. There's all kinds of things that we could run internally. And this is where I think being a slightly larger firm helps, because if I was let's say a 20 partner firm at Excel or Summit or TA or someone, you better believe I'd have an analyst crunching and combing through this data to be able to give my partners some kind of estimates on, you know, all of the different transactions that have been done in the industry and what success characteristics look like, what failure characteristic looks like, and so on. Okay. Christine?
Yeah, I was just going to make a quick comment. I think you mentioned, you know, whether the 2% NPV or the 400,000 is really enough, right? Especially when we haven't considered fees and carry. I think oftentimes the LP companies, I know, you know, mine, I'll just hint, you know, I think we debate this internally is, what is our own investment strategy, especially from a portfolio perspective? Oftentimes our senior executives are have wide networks. They know someone who knows someone. This sounds like a great investment opportunity. The numbers pan out. But what is the inherent return percentage for the LPs, right? Based on the shares that they put in or the investments they put in. I think oftentimes the LP companies may not necessarily know or can direct that for their VC partners. And I think that that's actually important from a long-term strategic investment perspective and innovation perspectives as well.
Yeah, but at the same time, right? I mean, the LP is the word limited, right? Limited partner.
Right.
They're only going to have so much access to this information. There's going to be a lot of trust that they put in the general partner to make the right investments on their behalf. And I want, if I'm a limited partner, I want two things. Number one, I want a GP that has skill in an area where they can earn outsized returns. And there's a huge push for that in the LP community. I don't want you just winging it, going whatever opportunities you find. I want you to tell me what your specific skill is that allows you to earn outsized returns. And that's going to be a certain dollar threshold, certain industries, certain capabilities. And then I'm hoping that you have the right mathematics in place to find companies that have large enough opportunities to pay for all these failures. Because you, like many other people, no matter who you is, you're going to have a lot of failures because the numbers aren't good. Half to 60% of all deals fail because we're not very good at teasing out value propositions. But that's okay, because when you do win, you win big. And so have you gotten an appreciation for how large you need to win in order to be successful?
Right.
But I agree with you. I want to hear what your investment thesis is. I've got to buy into it, and I got to buy into you that you're going to manage my money well, because I'm not going to have everyday access to every deal that you're combing through.
Correct.
Alexandra?
So obviously this form of an approach and evaluation is very quantitative. And if you take a step back towards last week when we talked about business models, obviously there's other factors here at play outside of pure numbers. So if you think about talent, we talked about leadership, we talked about product market fit, a variety of things that can shift and are quite qualitative. From your perspective, when do those, like, what does the layering of all those things look like? And actually, sequentially, does this come before the qualitative pieces do?
Yeah, so let me draw one last thing for you. Think about it like a window like this. Here's the VC method. Here's the sweet spot. And here is a full-blown DCF model. Alexandra, if I were doing this professionally, I'd want to start with the VC method, sort of in the middle. If I felt as if the data was pretty good, but there were complexities I couldn't deal with based on the simple VC method, I'd move to a DCF model. More likely, because I'm doing early stage investment, my data is going to be terrible. And there's going to be a lot of variation based on this data. I'm probably going to shade more towards the sweet spot just because I have to. So I want to start with the VC method, but then I'm going to have to either go left or right, depending on how good my data is, depending on how mature the company is, depending on how I feel about the situation. If I've got a company in which they don't even really have a business plan, they're just asking me to write a check, I'm going to have to use the sweet spot method, right? I have no idea how large your market is. I don't even know what your market's going to be. I can't answer any of these questions. So I'll tell you what, I'll give you $1 million to figure out whatever you're going to figure out, but I want a third of your firm. Well, congratulations, with no data or anything. I just valued it at $3 million. Do I feel comfortable with that, right? So I think it really depends on sort of how much data you have, how comfortable you feel with the data. Are you going to go left on this model? Are you going to go right? Okay. All right. Guys, it's 25 minutes after the hour. I'm going to suggest we take a 15-minute break. When you come back, I want to start talking about how these valuations make it into the term sheet, because the term sheet language is going to be slightly different. And then what we'll start the conversation on, although we won't get very far because we're going to end at 1 o'clock today, I want to start talking about preferred stock valuation. What we're talking about right now is enterprise level valuation. I want to start talking about how different kinds of securities can grab at this enterprise value, because the 5.4 million assumed common stock. We're not going to do that anymore. We're going to start thinking about, all right, how do we put these numbers into an options model? All right, go take 15 minutes. That means we're back at 40 minutes after the hour, 40. All right, guys, we'll see you in a couple minutes. Payman, did you want to say something?
Yeah, just a quick question. I was just going back review my notes. So at the beginning, when we came up with 192 million valuation, so we consider the multiple 12 and also 1/3 of the share. So I'm having a little bit trouble of, so if those, multiples and 1/3 it changes, or how we really guesstimate those properly, so to come up with that valuation. Is it?
Well, as I said before, there's going to be a tremendous amount of noise. That's why, people revert to the sweet spot methodology, because they don't feel comfortable estimating the inputs. Right. With that being said, we're going to collect as much data as we possibly can. And Payman, even if we can't put numbers behind them, we can still ask questions. Is this a large or a small market? I personally think that Learn Zillion's market is much larger than Goldbook's.
Okay.
I don't know how much larger, but I think it's larger. Question number 2, how crowded is the space? Well, Learn Zillion has a lot more competitors. Goldbook has just one. So I think we can talk about how crowded the space is.
Okay.
So I'm not any better at this than you are. I mean, how many teachers are going to convert to the Learn Zillion platform? I don't know. But I want to start with some data, right? How many teachers are there? And then we can start to run some sensitivity analysis on this.
Okay.
Okay.
Thanks.
But at the end of the day, Payman, I think most people are using the sweet spot, right? Which is, we don't really know much about either of these markets. And so the question is, what percentage ownership do we need to feel comfortable with the incentives and the remuneration? And how much money do we think this company needs to get to the next milestone?
Yeah, correct. Thanks, David.
My pleasure. Other questions before we start, guys?
Yes, are there guidelines as to at what point in the maturity of the company you have enough data to start using a more traditional DCF? Is it like after Series C or after a number of years from inception?
Well, if you're talking about a true seed stage where there's nothing, not even a working prototype, Jose, my guess is you're going to use the sweet spot method. If you're in a Series A, you're going to try and use the VC method, because I don't think it makes sense to not at all at least attempt to size the market or think about how crowded the space is. And then I agree with you. By the time you get to a Series C or D, you're probably 4 or 5 years into this. You've got a model that you can start putting together a DCF. And that's exactly why I was hired. I wasn't hired for HarborVest to source deals or to really talk about the potential for value creation and the value proposition. I was hired to do DCF modeling. I just didn't realize it at the time. And that's because these guys did Series D, Series E stage stuff. By the time I got my hands on it, they were revenue, profit positive. Like, it was pretty far along. Many people might even consider where they were at was growth equity, but it was traditional VC. Leonardo?
Yeah, I have two questions. One is already in the chat and was asked by others. If it's possible to have kind of a summary or your notes on the slides, just to being able to go through the logic of the numbers again.
Well, Leonardo, if someone else wants to post their notes, they can. I don't keep my notes, but if you sneak a picture, feel free. I won't. So if like you capture a snapshot of something with your phone, totally fine. I just don't keep my notes because it gets too cumbersome. I teach too many classes.
Okay. And the other question.
Go on.
Yeah, the other question was, I'm in the life science industry, so getting many of these answers to these questions is very tricky, especially if you are extremely early. So in those cases, what do? Do you do the sweet spot and that's it? Or?
You know what, Leonardo, I don't know if I agree. I think it's tricky everywhere. And to a certain extent, I like medicine better because I can think about how many patients there are and how many people have a chance at this technology. So if somebody comes into me and says, I'm going to handle lactose intolerance, I have right now a company, I'm a former student of mine that's building a company around lactose intolerance. We know how many people are lactose intolerant. We know how many people have some science in the area. So I would argue that life sciences is just as difficult as every other space. The only thing that we don't know is the technology working or not. And that's going to require, talking with medical doctors and having them assess probabilities. And I don't have it here, but I've seen it. There is language that you can use. If you search on the web, you can find it, about translating loose language from engineers into probabilities, right? Where, like, it's definitely going to happen means 90%, right? It's somewhat likely means 66. So there is almost a language scale that you can build to assess people's probabilities. And perhaps you poll 10 or 30 people on what you think the likeliness of something occurring is, and then translate that to a physical probability. Chris?
Yes, David, I have a question. Like usually, well, this is just like it's not numbers, but from your experience, usually from the seed going into the Series A, the value of the company usually has been gone up. My question is usually how many times the value of the company after when they are in the Series A levels.
Yeah, so you can take a look here at the data on page 18, and it will give you a bit of a feel for that. So notice that seed was 2 million in for about 21% of the company.
Right.
This is 6 million in for 23% of the company.
3 times.
But Chris, that's a bridge too far for David Wessels. This idea that, hey, if I raise my next round of financing, I deserve a higher valuation. That I'm not there. I won't go down that path. That is so backwards looking and rewarding for past performance. And I don't like it. I'm at the very least going to stand at this moment in time and do everything I can to look forward and say, okay, how much money do you need going forward? How much ownership do I need to keep you honest going forward? This idea that sometimes people have about rewarding, well, you did a seed at this, so you deserve at least 4 times this much money for the next round. That's a bridge too far for me. I'm not saying I'll ignore the information. I don't know. I don't know. I'm not there, Chris. Does that make sense?
Yep.
And I hear people argue for it a lot. So clearly there's something there, but I feel it's too much rewarding for the past, and I want to be entirely forward looking in my valuation work. Christine, did you still have a question or comment?
No, I agree with you on that one. I think especially as an investor into a fund, I think it's difficult to say, okay, yeah, you hit some of your milestones. Now all of a sudden you're worth X many times more. I agree with you.
Even worse, Christine, hey, you've burned through all your cash and you need to raise capital. Now you're worth more.
Right.
Right? I mean, you see someone taking it down that path. That's like,
Right. And now you have 40 people in the company rather than 5. And so you're telling me you have a higher burn rate. Well, of course you do.
Yeah. Again, believe it or not, guys, when I use a simplified model, I'm still trying to follow core economic principles that are robust. It's just that we don't have great data. So we take shortcuts where we don't have good data. And we just be very careful about making sure those shortcuts are robust. But again, this one's a bridge too far. Patrick?
So I don't know if this is necessarily something to cover now. I'm wondering if it'll be covered at some point. The different kinds of valuation. IRR is one mechanism, but I'm in a couple funds that are constantly publishing quarterly NAVs, net asset value numbers, and I'd love to learn how to reconcile these different metrics.
Yeah, so I think that, Patrick, a net asset value is a snapshot in time on sort of what the portfolio is currently worth, whereas an internal rate of return is often calculated when you're making the investment on what you think you're going to earn based on the success scenario versus what you need to earn in order to break even. If we're taking a look at the performance of a fund, then you're right. We also might compute an IRR there as well to see ex post, what have they actually done? And then we can use that to compare across funds. But beyond that, no, that's really more LPGP stuff. And so I'll let Bill Gay, talk about the pros and cons of the various methodologies, because internal rate of return's got a whole bunch of mess associated with it. Very hard to use as a metric consistently. Any other questions? Jose, I think your hand went up post. We're coming back as well.
Yeah, I just wanted to share, because I was in a somewhat similar spot to the situation Chris described 3 months ago, in the sense that we're talking to the startup who's raising a Series B, still pre-revenue, and they have something that they were framing as a milestone to justify a valuation that was 4 times the post money of the valuation ascribed to the Series A 3 years prior. But they haven't really done much. They just have an agreement that says that someone will sell their product, and they were discounting that and saying, because of this, we're worth X, and that implied 4X. And somewhat that sort of anchored the discussions. And then we were on the camp of what you said, David, let me just do my math, or math that we can agree, and we were coming in at 2X. And ultimately that whole thing led to going to PitchBook and downloading valuations of actually recorded rounds, assuming the PitchBook data is good, on over like 50 companies in the novel food and beverage ingredient space. And the median was pretty consistent. The median was that the value uplift multiple from round to round ended up being 1.8, slightly below 2X. So I don't know if that's a coincidence, but just wanted to share that as some empirical data to contrast,
So, I'm going to be nicer than this.
Slightly below 2X.
Jose, I'm going to be nicer than this in real life, but you better believe if I were doing this professionally, I'd have this in my back pocket. I would have in my back pocket the names of 10 well-known companies that have done a down round, where their valuation in a Series B or a Series C was lower than the previous round, just to re-anchor that conversation and be like, guys, I know you think you deserve something because you did your last round at X, but here are 10 companies, including A, B, C, and just rail them off one after another, that all did down rounds, where their valuations were lower, not higher, because they weren't making enough progress towards the milestones. Congratulations, you met a milestone. It wasn't enough progress. You should have made more by now. And so, Jose, I'm going to try and, like you said, re-anchor back to, something other than this rule that you should earn 2x your last round or 4x your last round just because you're raising additional capital. It's just not, that's too far for me. All right, let's jump into the next lecture note. We don't have a lot of time together. We only have about an hour. And we clearly won't make it through this entire lecture note. I never planned to. But at the very least, I want to make it through the term sheet language. And then hopefully even get just a little bit into the payoff diagram so that when you meet, if you meet with Bill Gay around option pricing, you know why we're doing what we're doing. But we won't get very far into this lecture note just because, again, lots of discussion, lots of examples, and we'll take some time. So when we talk about the term sheet, and Kevin's going to talk about it really in depth. Term sheets, his 2-day stint with you. I'm only talking about one aspect of it, and that's the valuation of the company and the valuation of the securities. But just be aware, a term sheet's going to have a lot of terms in it, about 20 different terms that you can negotiate. It might be 4 or 5 pages in length, and I'm going to focus just on 2 of them. Well, maybe even 3. I'm going to focus on the valuation of the company. I do want to spend a little bit of time talking about option pools because that will affect the valuation as well. And then also the type of security. And in this case, it's going to be a preferred stock. And we're going to talk about different kinds of preferences because this will affect the value as well. So all 3 of these things are going to affect the value. But then other things like board compositions and rights, such as the right of first refusal and registration rights and drag along rights and all these little nooks and crannies. This is what Kevin's going to talk about. And he's going to repeat some of the stuff I talk about as well, just because, again, repetition from 2 different perspectives is extremely helpful. And he'll also bring a different spin on it as well, which I think you'll find interesting. Let's talk about the first issue, valuation. So I had done my couple years in the McKinsey valuation practice. I had graduated with a degree in valuation from Wharton, and I got to VC. And I thought I knew everything, but I was young and dumb. And I sat in my first meeting, and this is what the venture capitalist said. I'll put in 4 based on 6 pre. I'm looking for 2/5 of the company post, and for that, I'll put up the 4. It's worth 6 pre, and I want to own 40% after we close. I had no idea what this meant. I had never heard any of this language before. For what? What are they talking about for, and what the heck does pre mean? I've never heard of that. What do you mean 2/5 of the company post? Post what? All 3 of these things mean what, guys? Even though we're saying it's slightly different, all 3 of these things mean what, Jonathan?
Sorry, I was on mute. Just the valuation, pre-money, post-money, what you're going to get for the $4 million that you're putting into the company.
Yeah, so all these things mean the same thing. It's just that in valuation, because I was always working in the secondary markets, I was always trading securities versus investing in companies. I had never heard of pre and post money, right? It wasn't like I wasn't doing valuation. It's just that I was buying the entire company. There was no money going into the company. All of the money were going to the target shareholders. And so that makes the language quite different. In this particular case, the money is actually going into the company, which is very different than if the money goes to the target shareholders. That's more of a secondary transaction. This is like a primary transaction. What I wish I had was slide 29. Slide 29 is my cheat sheet. It's all the formulas you need to know in one place. And the reason I've numbered them the way I've done is because I think you sort of work through the formulas in this sequence. Let's do an example, and then I'll show you where the formulas come from. There's really only one formula that needs to be derived, and that's formula number 3. The rest of the formulas are pretty straightforward. Okay. Formula number 1. What percentage of the company is the VC taking? Well, if they say they're taking 40% of the company post, and for that they're going to put up 4 million, that's equal to the new money. New money means money going into the company in the most recent round. It's the new money entering into the company. So what does this equation look like? Well, the VC is taking how much? 40%. The new money is what? 4 million. And so therefore, the post-money valuation can be calculated. And we've already done this earlier, right? We already turned this equation around. So this means the post-money valuation is equal to the new money divided by the percentage ownership. So what's my post-money valuation?
10 million.
10 million. So post-money is 10. So that's equation number 1. And that's based on the 2 inputs in every term sheet. How much of the company do you want to own on a post-money basis? And how much are you willing to give me? If you remember in our last example, it was 5 million for 25% of the company. This is 4 million for 40%. Next, equation number 2, pre versus post-money. The post-money is equal to 10. The new money is equal to 4. So therefore, what's our pre-money valuation?
0.4, 40%.
Nope. So pre-money plus
6.
new money equals post.
6.
Oh,
6.
yeah.
So 6 plus 4 equals 10. So if I know the post-money valuation, I know the new money valuation, I can always come up with the pre-money valuation. So 10 minus 4 is equal to 6. The next equation is not straightforward. The next equation needs to be derived, and I'll do that on the next slide. I need to know how many shares we're going to issue. And so here's the equation. What does VCS stand for? These are the shares issued. What does VCP stand for? Those are the percentage the VC wants to own. What does FS stand for? FS stands for the shares held by the founder. So let's say that our company, the founder's company, has 3 million shares outstanding before any financing was done. And usually the attorneys will set up the company to have lots of shares. And the reason they do this is to avoid partial shares, right? These numbers are going to lead to decimal points. And to avoid the decimal points, we want a pretty big number of shares outstanding. 2 million, 3 million, 10 million. How many shares you have outstanding doesn't really matter. It will affect the share price, but it won't affect the valuation. All right, so let's see if we can do this. What percentage of the company does the VC want to own?
%40.
40%. So that's the numerator. Divided by 1 minus 40%. All times 3 million. Where am I getting 3 million from?
Shares of the founders.
That's the shares of the founder. Can you run those numbers for me? .4 divided by 1 minus 0.4, all times 3.
200,000.
How much?
200,000.
I don't think it's 200,000. That sounds
2
too
million.
small for 40% of the company.
2 million shares.
2 million?
Yep.
So 0.4 over 0.6 times 3 equals 2 million. Who are these shares going to? These shares are going to who?
Investor.
The VC?
Yeah, so this is 2 million shares going to the venture capitalist. So at the end of the day, what will the venture capitalist own? they will own 2 over 2 plus 3, which is how much? 40%.
40%.
We're just double checking our work. So the venture capitalists will own 2 million shares. The founder will own 3 million shares, and they're going to own 40% of the company. Final equation, what's the share price? And I'm going to let you practice this. I'm going to give you an example in just a moment. Equation number 4. What's the money we're issuing? How much new money is there?
$4 million.
$4 million.
$4 million divided by 2 million. $2.
Divided by 2 million shares. And so what's my price per share?
$2.
$2.
$2 per share. You're going to do this probably 5, maybe even 10 times this week. So you'll get lots of practice. And my guess is by the time you do this a 10th time, you'll be really fast at it. But for me, I like to have this little cheat sheet. It's the same every time. Start with equation 1, move to equation 4. This is the mathematics cheat sheet of the term sheet. Okay? So again, where do we start? 40% of the company for 4 million. That's the standard discussion that you and the founder are having. This gives us a post-money valuation. To compute the pre-money valuation, we subtract out the new money. Pre-money plus new money equals post-money. That's a standard rule. Number 3, if we want to compute the share count for the venture capitalist, we take P over 1 minus P, all times the founder shares. So what percentage are they looking for? Over 1 minus that number times the founder shares. That will give us the appropriate share count. I'll prove that on the next slide. And then finally, to come up with the price per share, we take the new money divided by those shares, and we come up with a price per share, and that's the issue share. So this just, again, can be implemented in a spreadsheet. Boom, 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 boom. 4 equations each and every time we do it. Okay? Any questions about the language or the mechanics? And again, you're going to have a chance to practice this with your group in just a moment. Any questions, comments? All right, let me show you the one equation we didn't derive. And that is the equation for the number of shares that the VC is going to have. And the reason this becomes important is because when we get more complex later, we're going to need to adjust these equations. So for instance, if we have convertible debt or any angel financing, we're going to have to start doing these equations with a different set of numbers. So how do we start? This is 40% equals 2 over 2 plus 3. That's what this equation says. P stands for the percentage ownership that the VC is looking for. The VC is the VC number of shares, and the F is the founder number of shares. Everybody see on equation 1 on slide 30 how it ties the previous page? Right? That's just definitional. That's just definitional. What percentage of the company is the VC own? That's equal to the VC shares divided by the total number of shares. We're going to take the denominator, move it to the right. Everybody see how I did that? Just multiplied both sides by VC plus F.
Yep.
We're going to take F times P. There's F times P. We're going to take the other P times VC and move it to the right. That's why it becomes a minus sign. So we're going to take P times VC, move it to the other side. We're going to take F times P and keep it there. We're going to reconnect these. Notice we have VC minus P times VC. That's just 1 minus P. We still have P times F on the left. We've moved the P to the other side. And we're done. I went through that quickly on purpose. In my 30 years of doing this, I've never been in a board meeting in a venture capital situation where someone says, yes, but can you derive that? No one's going to ask you for these derivations, right? But for those of you who want to see where these numbers come from, this is where they come from. And so don't worry about the derivation. We're not going to really need it. I just wanted to show you where it came from. The question is, can you implement it on page 3? There's the equation right there on page 3. Everybody see it? Okay. Those are the 4 formulas. Any questions with my 4 formulas? And I'm going to give you a chance to practice them again, but only after we issue some employee options. Then you'll get to see how it affects. All right, here we go. Issue number 2, employee options. You have successfully negotiated a $4 million investment on a $6 million pre-money valuation by pitting your firm, Red Cap Ventures, against Blue Shirt Capital. Triumphant, you return to your company's loft to tell your team, as a founder, you've created $6 million of value. Everybody wants to know how much their stake is worth, right? Everybody, all your employees are desperate to know, how much am I worth? How much am I worth? And you explain the company currently has 3 million shares outstanding. So therefore, $6 million of pre-money value divided by the 3 million shares that are currently outstanding owned by the founders equals $2 a share, which is what you issued the shares at on the previous page. Later that evening, you review the term sheet from Red Cap, but it states the share price is only $1.50. This must be a mistake. Reading on, the term sheet states that the $6 million pre-money valuation will also include an option pool equal 15% of the post-money share count. This option pool isn't for current employees. This option pool is for who?
Future employees.
For future employees. These are employees that don't either work for the firm, or this is for future share grants to current employees, but only if they earn them. You call your lawyer and your lawyer explains that the so-called pre-money valuation always includes a large unallocated option pool for new employees. Your stomach sinks, you feel duped, and you're left wondering, how am I going to explain this to the team? Okay? All right. So what's going on from a valuation perspective? Let's take a look at the next slide. I'm going to send you off to a team room. Is that all right, Alan? Are we good to go? We can send them to the same teams or different teams, totally up to you.
Yep, same teams, that works.
I want you to run the exact same numbers with one change. Here's the only change. That number right there. What did we say that was going to be equal to? 15%. Because it's almost like we're allocating 15% to another VC called the future employees. But how much money are we getting from those future employees? Well, right now we're not getting anything from those future employees. So it only affects the share count. It doesn't affect the money coming in. The new money is still 4 million. What I would like you to do as a group is I'd like you to go through all 4 equations slowly, making sure that everybody understands each and every equation. Many of the equations will be the same because the only thing we're doing now is adding 15% to this unnamed investor called the future employee. And notice the equation looks very similar. So this is 40%. Well, it's not 40%. These are the share counts. This is 40%. These are numbers of shares. Your key is down here. Okay? All right, let's send them off for a couple of minutes. Please, leaders teaching leaders, use this to explain to your colleagues what the heck is going on. All right, we'll send you off.
Opening our rooms now.
All right, guys, we'll see you in a couple of minutes. See if you can do it. Slide 32. All right, welcome back, everybody. I realize many of you have done it on a spreadsheet, but in this particular case, I'm not sure the spreadsheet helps just because it hides a lot of the mathematics. The nice thing about a spreadsheet is once we have it, we can just apply it again and again. But maybe, Stephen, is it possible to step me through some of these numbers and we'll work through it together?
But actually, probably Christine did a lot of the work, and she might be better to talk about it than.
Okay.
She's got the slide.
Christine, this is the true sign of leadership, throwing someone else under the bus.
Yeah, that's okay. I don't mind. You can tell me if our math is wrong.
What does that first equation look like?
The first equation we've got is here. Can I share screen, actually, David?
Sure, and I'm gonna. Well, I prefer to keep it on slide 32 because I'd like to keep all the math the same. So on this one, sure. If we just speak through the numbers, what does that first equation look like? What's my new money?
The new money is 4.
Yep. And what's my percentage that I'm looking for?
40%.
So 40% here, new money, 4 million here, sorry. And I'm solving for X. And so what's my post-money valuation?
Should be 10.
But wasn't it 10 before?
Yes.
Notice it doesn't change. Everybody see that? The post-money valuation has nothing to do with the employees because no money is going into the company. It literally is about the percentage ownership the VC wants for how much money they're giving the founder. Everybody got that? That number did not change, even though we now did a big issuance.
It's back to the sweet spot, right, David?
Yep, exactly. It's the sweet spot. It's that simple. But my point is, notice it didn't change between the last example and this example. All right, so Christine, post money's 10. What's the new money?
I'm sorry, 4.
And what's the pre-money?
6.
Notice that this did not change either, right, Christine?
Right.
That even though we issued all these shares to future employees, none of these numbers and equations 1 and 2 changed. All right, now it will start changing, right, Christine?
Right.
What are these numbers here? So what percentage is the VC looking for?
40% divided by 1 minus 15% for the employee pool minus the 40% of the VC percentage multiplied by 3.
Perfect. Perfect. And what's the number of VC shares?
We got 2.6 million.
Yep. In fact, it's 2.67 million if you want to be precise.
Okay.
It's actually 2.66667, right? The 6s repeat for a while. Well, how many shares were we issuing before, Christine?
2.
Notice that because we're now issuing employee shares, the VC wants more shares. They don't want to be diluted, so they want more shares. And how many employee shares will there be in our bucket?
So it would be the 15%, right, of the final share count. We're starting out from a 3 million perspective, right, from the founders.
And what's in the denominator there? 1 minus what? 0.15 minus 0.40.
0.4.
Did you run those numbers?
We did not run that one.
Anyone know what those numbers would be?
Yeah, we didn't run that one.
1 million.
1 million.
1 million.
Those shares are going to be placed in a bucket. That bucket will be saved for a later date when we hire new employees. Everybody with me? All right, finish this out.
So then,
what's the new money coming in?
4 million.
And how many shares are we now issuing?
2.67.
And so what's our price per share?
So let me recalculate, because originally we got 1.54, but then we were using 2.6, not 2.67.
1.5.
So 1.5, yeah.
That's where the $1.50 is coming from. I'm not going to have you do it because we're short on time. We're always short on time, but that's okay. But imagine if I started playing with the employee share count number, right? Imagine if I said, well, what if the option pool isn't 15%, it's 25%? you could start thinking about how that affects the share price. So all of these numbers you could put into a spreadsheet and start doing sensitivity analysis on. But at the end of the day, notice that no matter what I put in for the employee percentage, it doesn't change the pre or post money valuations. It only changes the share price. Christine, did you get a chance to put any of these numbers into the term sheet?
Yeah, so hold on, let me look at my version. So Red Ventures is looking for 2.67 million shares at 40% ownership. Amount raised is 4 million, including, we said 0 from conversions because.
Yeah, there's no bridge notes outstanding. Sometimes a company will raise debt between rounds from its existing investors, but we don't have any intermediate rounds, so we don't have to worry about the conversion of those bridge notes. All
right. And then 1.5 per share.
150 per share. Okay.
Yeah, and pre-money valuation of 6 million. And fully diluted post-money valuation of, actually.
Well, you have the post-money right here. Where's the post-money?
Yeah, it was 10 million.
That's right.
And then we didn't get to the final one.
Including an employee pool representing what percentage of the fully diluted post-money capitalization?
15%, right? I think.
That's right. That's it.
Okay.
Sorry, I'm not meaning to bounce around. My pen is jumping around. So 15%.
Yeah.
This term sheet that I'm filling out right now is available. It's a standard term sheet. It's available at the following website on page 27. Everybody see the website? nvca.org, model legal documents. If you haven't seen it already through Bill Gay, I don't know if he shows this, but a standard term sheet's available. And that's exactly what you're filling out right now on slide 33. I just took the NVCA, National Venture Capital Association term sheet, and I just downloaded it to slide 33. And so what you're literally filling in right now is the actual term sheet provided by the NVCA. The only thing that you need to do is remove the brackets, agreed? Right? So just get rid of those brackets, but literally it's a plug and play model. In fact, I'm surprised they haven't automated it yet by asking you questions online and then having it kick out the term sheet. But you can just fill it out. It's a Word document, easy to use. Christine, you want to finish it up? You've done a great job. You want to tell me what the cap table looks like?
We haven't gotten there, but we can give it a shot.
Yeah, let's do it together.
Yeah, so the common stock employee options would be at 15%, right?
Okay.
And it would be at, what do we say the number of shares were? Sorry, I have to go back to my notes here.
Anybody remember how many shares the employees had?
We said
1 million.
1 million. Shares. Thank you.
And how many shares did the founders own?
3 million.
3 million.
And what about Red Cap Ventures? What are we giving them?
2.67.
2.667.
Yeah. At 40%. Yeah.
40 plus 15 is what? 55?
55.
So that means the founder now owns 45% of the fully diluted shares. The valuation was how much?
10 million.
And so the share price was
1.5.
1.5
per share. Notice the cap table is just an exhibit to the term sheet. It just takes all the legal language from the term sheet and puts it into an Excel table, makes it a little bit easier to see. You'll notice at the bottom of the page, I have one trick of the trade. This is, learned through the School of Hard Knocks. Be really careful when building your cap tables, because especially if you're in an early round of financing and there's never been professional money, my guess is that there are things that might have gotten lost right? We think that this stuff is clean. These are not publicly traded companies. These are privately financed companies, often with their cap tables on the back of a napkin. You don't want to discover a year into your investment that Uncle Johnny has a legal contract he wrote with the firm to have an extra 8 million shares that he put in for $10,000 back in 1991, right? So don't assume that they have a clean cap table. This is what due diligence is all about. You are going to have to ask 5 million times, is there anyone else who owns shares in the company? Are there any promises that you've made to anyone who's given you any kind of capital? Because, you know, this stuff is, yeah, it's supposed to be filed. It's supposed to be done with a clean accounting firm. But if you're talking about a privately held firm that's growing quickly without a CFO, who knows what's happened? Is that clear to everybody? Do not assume the cap tables are rock solid. You've got to go through them and make sure that there's no, hidden landmines. I never had to worry about this as much when I was doing a Series C and a Series D. Once you've had professional money in there for a while, hopefully they have a professional accounting firm, a Deloitte, right, a PwC that's in there auditing these things, keeping the noses clean. But there's a really good chance that if you're doing a seed stage, with a privately held company, the accountant is someone's brother and this stuff is all sloppy. Make sense? Comments, questions, concerns?
One question, pre-money, this company was, the founders owned 100% of a $6 million company.
They did.
And now they own apparently 4.5 million. So they now are worth less. Why would they pull the trigger on this deal?
So I agree it's worth less in the sense that you've given extra dilution to your employees, your future employees. I agree with you that from that perspective, it's quote worth less. But I don't know if I read too much into that because the pre-money number is a little misleading. Maybe we should be considering the pre-money number to also include those other share counts. At the end of the day, we've got to feel comfortable, Roberto, with this valuation. Do we believe that this valuation is appropriate for what our ownership stake is as the founder? But I agree that the 15% money that you're giving to future employees is a real sticking point, Roberto. And if it's okay, I'd like to talk about it for just a moment.
Yeah, one question in that regard. I read that in Europe, VCs are more flexible when negotiating the employee option pool. Like not only the founders have to pay for that.
Roberto, I think that any founder and any VC, you need to be flexible. This is a transaction between two individuals, and you're going to have to negotiate. I mean, this is what negotiation is all about, and this is what Kevin's going to talk about in depth, in length. But let's talk about it just for a moment. Come to slide 36. What Roberto is talking about is what Mark Pincus was concerned about. He's the founder of Zynga. He's also a Wharton alumnus. Option pools. It's just another way to lower my price as a founder. When Fred Wilson, who's a very well-known New York-based venture capitalist, and Mark Pincus were negotiating the first round of Zynga, we got into a real tussle about this provision. Mark did not want an option pool in the pre-money valuation, and I did. But once we agreed that this was just a fight about price, the conversation got easier. I got him to give me an estimate of the pool he would need in order to attract new employees. We then added it to the valuation we had agreed to. He got his increase in price. I got my option pool. And of course, with Zynga, I got one of the best investments I've ever made. So getting to your point, this is all negotiation about who takes what and when. At the end of the day, both players have to feel comfortable with the price. Let me show you an example of a little bit of craziness. And this is from one of my professors at Wharton who started a company and did extremely well with it. Yodel's first term sheet was from an investor who wanted a 50% of the company for its investment and also required the founders to set aside 30% for the stock option pool for the first investment in the company. That left just 20% for the founders. Can you imagine that? Right? They want half the company and they wanted 30% to go to an option pool for other employees. Eventually, Yodel got a far more reasonable term sheet from Bessemer Venture Partners. That's crazy. That's my commentary. Okay, so just be aware, there is no standard on this stuff. You know, people ask for very aggressive things, and you have to make the decision on whether or not you want to fight back. What do some numbers look like? Jody Thielander, she puts together all kinds of option numbers in the Valley. Take a look at the attached article at the bottom of page 38, and you can take a look at what some current numbers look like. But these are just various option pools in the US based on different financing amounts. The difference between the bars, these are the medians. And the others are 25th and 75th percentile. So that's what the bars mean, just the 25th and 75th percentiles. Okay, but you can see the option pool, you know, a little bit, you know, bouncing around, but right around the 15% number. But they do vary, especially for really small deals, they vary quite a bit. Okay, any questions, comments, concerns?
I'm interested in the motivation. Yeah, I'm interested in the motivation for the size of the pool, the option pool size. So do you want to, is the idea that you want to have the option pool size in order to attract future talent? Are there any other factors that go into?
So what I'm looking at as an investor is I'm thinking, who do we still need to attract, and we'll never be able to pay them the salary necessary to bring them in. So if I need a new chief marketing officer, if I need another 30 engineers, if I need, you know, these employees, what kind of share grants will they be expecting in order to jump ship and come to my company? And there are groups out there that will help us with this, right? I mean, this is a well-established field now, so I can hire a compensation consultant to help me think through what my hiring needs look like and how much of the firm they're going to demand. And a lot of that's going to depend on what number employee they are. If they're the chief marketing officer and they're employee number 7, they're going to demand a lot more than if they're a junior engineer and they're employee number 700, right? I mean, there's going to be big differences between the two. But the bottom line is the investor is going to typically push for more. They want all the flexibility in the world to hire people, but the founder is going to push for less. Why is the founder going to push for less, Kirsten?
It dilutes the share.
It dilutes their valuation, right? So, you know, the Yodel example is a great example. They could have said yes to that transaction, and they would have started out of the box with just 20% of the company and then raise another 3 or 4 rounds. I mean, the founder could be down to 2%. And now all of a sudden your $30 million exit doesn't look so good anymore when you're at 2% of 30 million. That's not a very big number. I mean, it's certainly not pocket change, but is it really worth 10 years of your time for 30% of, or for 2% of 30 million? Not so clear anymore. Just taking a breath, seeing if there's any questions. Okay. That's a little bit about valuation in the term sheet. Now, we only have a couple minutes left, and then we'll take a break before Bill Gay comes on with his optional session. Is that right, Christina? We have till top of the hour?
Yep, that's correct.
Awesome. Okay. So come here to slide 14. Excuse me, slide 39. And what I'll do is I'll just talk about this for a few moments. I'll show you maybe 1 or 2 examples, and then we'll pick up again with this on Thursday, which is good because Kevin can come in and talk more about the term sheet, do a little bit of negotiation, and then we can come back and really put some heavy modeling behind this. What I would like to do, and I know Bill Gay talked a little bit about this, he's going to talk about option pricing this afternoon. I'd like to make sure that we have a real clear understanding of all the different kinds of contracts that can play a role in the term sheet. And this will affect the valuation. I've listed out 4 for you. The first one is a basic building block. Call it redeemable preferred. The second is probably the most common today. That's redeemable convertible preferred. The third is with participation rights, and the fourth puts a cap on it. These are all different items in the term sheet, and these will all have different claims on the firm. Now, to understand what claims they have on enterprise value so that we can value them later, we need to actually plot them out. And so I'm going to assume that we have already done our term sheet. Here's what our cap table looks like. You guys remember our company here? We purchased 2.67 million shares at $1.50 per share for 4 million in. Everybody remember that from the previous example? Okay, so now the question is, what kind of security do we have and how does this affect its valuation? We'll start with this today and then we'll do it in depth on Thursday after Bill Gay does the optional session. Okay, so come to slide 42. Let's talk about RP and then maybe we can touch on RCP for just a moment. RP is what I like to call a building block. It's not a realistic security because there is no conversion. It's just a security we can redeem back to the company at any time. Now, when we have a redemption, we often have a multiple of the redemption. We might have a 1 times liquidation preference, a 2 times liquidation preference. I've seen it as high as 10 times liquidation preference. What does a liquidation preference mean? It means when you give the security back to the founder and demand payment, you actually get X times your money. Now, if you have a liquidation preference of 1 times your money, that just means you get back what you put in. If you have a 2X liquidation preference, you get 2 times your money. 10X liquidation preference, 10 times your money. Now, to value this using options theory, we need to come up with something called an exit diagram. Some people call it a payoff diagram. This is what the security pays off on different states of the world. So here we have the enterprise value, and this is what the payoff equals. Well, let me start where we always start, right here. If the company is worth nothing at exit, how much do we get? This is an easy one. We get nothing. Everybody agree?
0, yes.
Yeah, so a payoff diagram always starts at 0, 0. And now the question is, where does it go next? Well, let's assume that the company liquidated for 2 million. That means that the company sold to a strategic investor for 2 million, which means we now have 2 million to split across the group. Well, if I, as the venture capitalist, have put in 4 million at a 2X liquidation preference, if this company really does liquidate for 2 million, how much is the venture capitalist going to get?
2 million. All of it.
They're
2
going to
million,
get
all of it.
In fact, Alexa, if this company liquidates for 5 million, who
All
gets
of
how
it.
much?
All of it until 8, at least.
Everybody see that? Until we get to 8 million, every dollar is going to go to the venture capitalist. Because at a 2x liquidation preference, any sale for below 8 million means we, the venture capitalist, get absolutely everything. What if the company liquidates for 20 million, Alexa? Then who gets what under an RP security? If the company liquidates for 20 million. Bum, bum. Now remember, this is not a convertible security. This is a redeemable security. I have the right to do only one thing, redeem it for 2 times what I put in. So if the company really does liquidate for 20 million, I get how much?
8 million.
40% of that.
I still get 8 million.
8 million.
In fact, I get 8 million no matter what happens forever. Because this is a redeemable security with no conversion feature. Right? It's just a building block. Not many investors would sign a contract like this, but this is what a payoff diagram looks like. Notice it has a slope of 1 until when?
8.
And then its slope is equal to what?
0.
0. Now, this doesn't look like any traditional option, doesn't look like a call option or a put option. We're going to have to work on that next week to make this into a set of call and put options. And once we know how to price options, we can price this security based on the work we've done to date. Here comes a trick question. You ready for it? Here's the trick question. True or false? This security has no upside. True or false? This security has no upside.
True.
True.
False. False.
It's false. Payman, why is it false?
Because the VC got 8 million, but there is left for the founders also.
No, I'm talking about the VC. From the VC perspective,
from
this
VC.
contract has no upside. True or false? Why is it false, Alex?
Because of the 2 times liquidation preference. So it's limited to 2, but it's an upside.
Everybody see that? It's got an upside. You put in 4, you can get out 8. That's doubling your money. That is upside. But Alex, it's what kind of upside? It's not unlimited upside, right?
Capped.
It's capped. Everybody see that? So this isn't a very attractive security. A lot of people want uncapped upside, and this is capped. Everybody see that? Okay. Let me show you one last security, and then we'll break, and you can come back if you'd like to see a little option theory. Back in the dark ages, when I was doing venture capital, even as early as the 1980s, we didn't have very complex securities. You used to get the following security. You got RP plus you got common stock. That's what you got given as a venture capitalist in the early days. Redeemable preferred plus a little bit of common. And what you would do is you would take your 4 million, and in the cap tables, you would split it. Some of it would be RP, and some of it would be common. Let's assume that 2 of the 4 million is going to be RP at 2 times. The other 2 million is going to give you 40% of the common stock. What do the payoff diagrams look like? Well, let's do the first one together. Start at 0, 0. What's 2 million at a 2 times liquidation preference for the RP security? We just did it. What does it look like? Any ideas?
4 million.
Satish, what does it look like? Start at 0, 0. What's our slope?
It'll go up to 45%.
Slope equals 1 up to 4 million. And then what happened with that security?
It'll get converted and
Nope.
it'll have us.
There's no conversion.
Oh, okay.
This is back in the old
Common
days.
shares. Right.
This is RP plus common. I'm just showing you every various kind of security because this may come back someday, right? This is an RP security, redeemable preferred. It is capped at 2 times. Everybody see my red graph? That's what it looks like. Now, as a venture capitalist, I'm not happy about having limited upside. I'm not happy about being capped. So what I did was I also took 40% of the company.
Right.
So what does that look like, Satish?
So it'll start out at 0 and it'll grow at a slope of 2 by 5.
What does that mean, a slope of 2 by 5?
Oh, it's 0.4%.
Is this what it looks like? The answer is no. Doesn't look like that. You can't take half of the 2 million.
Sorry. Yeah.
Why not? Why can't you take that money?
So at zero, you're going to get only $0 of the entire company. And then you're growing at, so up to the sale of 4 million, you have your redeemable preferred, which will give you back 4 million. And after
you
that,
get nothing for your common. Is that clear to everybody?
right.
Your common is worthless. There's no money to give your common. Every common shareholder gets nothing, including you as the venture capitalist. But Satish, once we hit that 4 million, how much do we get?
40% of anything above that.
Exactly. So there's your 40%. And here's your slope of 1. And here's your slope of 0. I actually get both shares, right? So let's finish it off in blue. If I get both, what does the slope look like?
So it's 1 until 4 million, and then it goes flat, slope of 0 till you hit the point.
Nope, because I get both.
Oh, sorry. Yeah, you get the 40% from below of whatever you get above that. Yeah, and it's parallel. Okay. So
this is RP plus common. Okay. This is what we mean by payoff diagrams. And as you can see, they can be a little bit complicated. So we have all kinds of securities. We have RP plus common. We have RCP. We have PCPS. We have PCPS with a cap. Each of these securities will have a different payoff diagram. And Kevin will talk about it. Bill Gay will talk about it. And I'll talk about it as well. Because the shape of the payoff diagram is going to affect the valuation. The shape of the payoff diagram will have a major impact on valuation. And that's what we need to do over the next couple of days. You and I, up until now, we've been working on enterprise value. What is the company worth? Now what we're talking about is what is our stake worth based on the language in the term sheet. And what my goal is by the end of the week, and this is with help from Bill Gay, this is with help from Kevin doing the term sheets, is by the time you come back to me and by the time we finish, that you will be able to put a dollar value, not just to the company, but every word in the term sheet, so that you can start making trade-offs with having a little cheat sheet by your side saying, hey, if you change this word, you just cost yourself 1.2 million, which is fine, but maybe you want to ask for something back in return that's worth 1.7. Does that make sense to everybody? Right? Because in a negotiation, you want this, I want that. Everything's worth something. And these payoff diagrams and the enterprise value work that we've been doing up until this point, you combine them together and you can start to put a dollar value to everything in the term sheet. Now, the one thing I'm not going to cover is I'm not going to cover how options are actually priced. This idea of what is Black-Scholes, what is a lattice, right? Like, how do we actually price a call option? How do we price an option? I'm not going to go through that. As Bill Gates said last week, I'm going to give you an Excel model that does it automatically. And this Excel model is a little bit of a black box. You can open up the VBA code so you can see where we apply Black-Scholes. But if you don't know how to price an option, it might be a little bit tricky. So whether you attend a Bill Gates session is really up to you, because I know some of you have seen options before, and others of you, you might be just happy with the black box, because we will give you a spreadsheet that does all the option pricing in the background. What it doesn't do is value the company. What it doesn't do is read the term sheet. You have to do that. You have to create the payoff diagrams, and it will do the rest for you. Okay? All right, Chris, any announcements? Are we going to take a 5-minute break? What's going to go on?
Oh, sorry, my mouse was not working. Nope. Hey, everybody. So we're going to take a 10-minute break till 1:15, I believe. And then you can come back for options pricing with Bill Gay. Tomorrow we start at the same time, 9:30. And that will be with Kevin Kaiser. He's going to talk about the term sheet and cap tables and corporate charters. Does anybody have any questions before we begin? Bill Gates is going to start at 1:15, and that's optional. So you're more than welcome to drop off if you need to, or please feel free to stay.
Yeah, is Bilge's session going to be recorded like the others?
Yes.
Okay.
Thank you, David.
All right, guys. I will
Thanks,
see you on
David.
Thursday. Have fun with Kevin. I know you will,
Thank you.
and then we'll wrap it all up.
Thank you.
For the week.
Thanks,
Take care,
David.
guys.
Thank you, Dave.
I hope everyone had a good start to the week. Now we are going to do this optional session. Things will get quite technical fairly quickly. I'd like to remind everyone that in terms of valuing these preferred stocks, convertible preferred stocks, and participating preferred, David, Professor Vessels, will have a black box for you. And you can do everything you need to do as a practitioner. This lecture is for those of us who want to understand what is in that black box and how you can actually build your own black box. Needless to say, this is quite ambitious, okay? So I just warn everyone, I will make everything fairly easy under the circumstances, but nevertheless, there's some complexity. Good news is that I'm going to give you a very intuitive background as to how you price these things. And then I am going to share with you, in fact, those are already shared with you in the Canvas site, some exact spreadsheets. All you will have to do is plug in numbers that you can actually price any kind of exotic security with those things fairly easily. So you will have your own, sort of say, inside of the black box. You can actually manipulate things and so on and so forth. In particular, underlying volatility is a very big ingredient in pricing options and derivatives. In the black box that David, Professor Vessel, is going to give you or share with you, there is an assumption about that, which is a middle of the road assumption about an average VC-backed portfolio company. Needless to say, some VC-backed portfolio companies are more volatile than others. So if you were to use the tool set that I'm going to give you, you can actually fine tune that kind of stuff, okay? With that understanding, let's start talking about basic stuff first and then build everything. So if you think about it, there is a course called Option Pricing taught to our MBAs and undergraduates, a semester-long course. I am going to teach you about 1/3 of it in an hour. Okay, so that obviously is very ambitious. Keep that in mind. But I'm going to keep it as simple as possible, as intuitive as possible. But you have to realize warrant pricing, convertible preferred stock pricing, and all these are fairly complicated issues. Many practitioners that work not only in the VC space, but investment banks and all, will not be able to do this correctly. Okay, just let me warn you that. All right. So this is kind of an artifact of coming to Wharton. So this is more than, you're getting more than you're probably asking for. Okay, that's why this is optional. Okay, let's start with discussing what a call option is. So you may have heard of this, even if you're not a finance person. Okay, so what is an option? Call option. Call option is a right, not an obligation, to buy the underlying stock at a pre-specified price in the next 6 months or 3 months in a basically specified time interval. Okay. There are two types of call options. One of them is American, the other is the European. For our purposes, it's not going to make a whole lot of difference, but European is going to give us a right to buy at a specific date, whereas American can be exercised anytime until maturity. All right, let's now start drawing these things. So these diagrams are very similar to the diagrams that we had before. On the x-axis, on the horizontal axis, we have the underlying asset. So this used to be the firm value at maturity, at exit. Now it's underlying asset at maturity. When you are pricing a call option, underlying asset will be the common stock of the company, because when you exercise a call option, you get to buy an additional stock of the company at the pre-specified price. Okay, so on the horizontal axis we have the call option. Call option comes with a strike price K. What is that? Some people call the striking price or strike price. It's the same thing. That is the price at which you're going to have an option to buy the stock. Let's assume we are looking at, just pick any company you'd like, Microsoft, okay? All right, or IBM, whatever your favorite company is. All right, let's assume you have an option to buy, in fact, let me make this even sexier, Tesla, okay? You have an option to buy Tesla stock at, let's say, $800, okay? When? Time to maturity, 6 months later. So in the next 6 months, you have this option. At the end of the 6 months, you have an option to buy Tesla at $800. What is it trading today? I mean, every day it moves a lot, quite a bit. Today, last time I looked, it was low 800s, 830 or something, okay? That's pretty high. It's one of probably the biggest bubbles of all times, but please don't short the Tesla stock just because I say so, because it can go further up and up and up. Okay. So, all right. So what does this payoff going to look like? 6 months from today, let's assume this is our K at $800. Okay. Let's assume Tesla is $700 6 months from today. Would you exercise this option? The answer is no. Why would you want to exercise an option? Because you need to pay $700. I'm sorry, you need to pay $800 to exercise the option and buy the stock. Okay, but the stock is sold for $700 today in the stock market 6 months from today, right? So there is no point for you to buy the stock through your option, exercising your option, because the market spot price is lower than your strike price. So if the price is less than your strike price, the payoff to that call option is zero, because you would never exercise it. But let's assume 6 months from today, Tesla stock goes up to $900. Would you exercise your option? Yes, because your option gives you a right to buy the stock at $800. Of course you'd like it. In fact, the payoff would be like this. This would be the 45-degree line. All right, that's a call option, the payoff of a call option. So basically it's nothing until the strike price and then the upside potential. That's the payoff diagram of a call option. All right, so far so good. If this is not clear to you and you find this confusing, your life will be quite horrible the next 45 minutes, okay? Please speak up now or be quiet. I'm joking, obviously, don't be quiet, but I think you just need to understand this basic stuff, okay? So this is a call option. There is also a put option, which is not going to be relevant for our lecture today. That would be not an option to buy, but it's actually option to sell. So if you have a right to sell a stock at K dollars 6 months from today, we call that a put option that is maturing 6 months from today. All right. Okay. So how do you value such a thing? All right. These things are traded in the marketplace, so people actually price this stuff. Okay. But there is also a mathematical way of pricing this stuff that is called Black-Scholes formula. This call option C can be actually calculated with the Black-Scholes formula, BS formula. In the BS formula, what you need is the current stock price. Let me put a star. Today, T stands for today, small t. Current stock price. Okay. We have the volatility of the underlying stock. This will be Tesla stock. We have time to maturity. We have risk-free rate. All those things will be part of the Black-Scholes formula. Okay. Obviously, the formula looks very crowded and all that. Those are the 4 important ingredients for our purposes. Okay. So if you know the stock's current price, if you know the volatility of the stock price, and if you know the time to maturity for your option, if you know the risk-free rate, you should be able to calculate the value theoretically. This may or may not be identical to the market prices that you observe, but it'll be very close. So Black-Scholes formula is invented by two gentlemen. Their last names were Black and Scholes. I mean, Black died fairly soon after that, so he didn't live long enough. But Myron Scholes lived long enough to win the Nobel Prize in economics to formulate this. So this is a pure mathematical induction, but it gets damn close pricing these things. So therefore, pretty much nowadays, every sophisticated investors price their call options and forecast the value of their options by Black-Scholes formula. I'm going to give you the formula in an exact spreadsheet. You will never need to do anything except that plug those four components into it. Okay. So in fact, there is already an exact spreadsheet on your Canvas site that calculates these call options for you. Let's move on. What is a warrant? Warrant is like a call option, okay? But when I am buying a call option, someone needs to sell me that call option. And if that someone has nothing to do with the company's treasury, we are taking a bet. For example, Chris may think, don't be offended by this, Chris, but let's say you think that Tesla is going to go further up. And if I think further the Tesla is going to go down, you and I, we may be able to agree at the price at which you sell me a call option and I buy it from you. If you're right and the stock price goes down, my call option at the end of the day will be worthless and you'll make money, I lose money. But if the stock, so if the, I'm sorry, I think I have confused the story. Let me back up. Chris thinks the Tesla stock is going to go down. I think it's going to go up. Okay. Then Chris will sell me a call option, and I buy this call option from him because I think it's going to go up. If it goes up, I exercise my option and I actually make money, and Chris loses money. But if its stock goes down, I'll never get to exercise my option. He makes the money by selling me that call option. So market will be made by basically people with difference of opinion. Okay, there is a question in the chat box. The Black-Scholes formula actually is for European call options, but if everything goes well under certain very generous settings, it never pays off to kill an option prematurely. Therefore, it will also give you the American call option. But the option to exercise early is not a valuable option, what I'm trying to say. But that's a whole different, more complicated issue. Let's ignore that for the moment, okay? All right. So now, what are we going to do now next? Okay, so now we are going to now introduce this concept that the call option will be sold or will be underwritten by the company itself. Meaning that if I have a call option and if I exercise it and the company takes the other side, we call it a warrant. It is different than the call option that we just described between Chris and I. How is that any different? Well, think of it this way. If when I get to exercise the call option, right, Chris pays the amount of money I make by exercising that option. But if Chris is a treasurer of the company, then company pays me. But if the company pays me, the company's stock will be losing blood. Why? Because the company is paying valuable cash to other investors, which means the value of the firm will go down. Obviously, with a one single option, it's going to go down in a negligible amount. But if there are many of these options outstanding, then the value will be diluted. Okay. The most common form of warrants are executive stock options. Why? When executives have a stock option, when they exercise the option, what happens? The treasury issues these additional stocks or simply pay the difference between the spot price and the exercise price to the executives, which means either way, it's going to dilute the value of the existing stock, right? So therefore, warrant is a special call option where exercising that call option is going to further dilute the value of the option. So you are buying the stock by exercising your stock option, but by doing that, you're diluting the further upside potential of the company, which means a warrant would look very similar to the call option, except slope here will be actually less than 45% line. So slope here will be less than 1. So that will be the warrant. So the difference between a call option and a warrant is that warrant is less valuable than the call option. Right? Does that make sense? Why? Because when you exercise your warrant, you are diluting the stock, underlying stock. Therefore, you're diluting yourself away. All right? So that's the difference. It turns out warrant pricing is really, really important to understand in order to price any of the convertible preferred stock or any of the convertible bonds. Why is that? What's the idea behind it? Let's assume you are holding a convertible preferred stock. What happens when you decide to exercise your convertible preferred stock? You will end up getting newly issued common stock, right? It is very similar to the warrants. Instead of paying the strike price of the company, you're surrendering your preferred stock as a strike price, but in return, just like a warrant, you get to buy additional shares of the company. So existing shareholders' claim on the company will get diluted by your exercise. So effectively, by holding a preferred stock, your optional part of it, the convertible to feature of that convertible preferred stock, looks like a warrant. So in order to price a convertible preferred stock, you need to price a warrant first. Let me draw this via diagram. This thing that I'm drawing, I'm obviously going to give it to you at the end of the day. Okay. So now we have this convertible bond, convertible preferred stock that can be converted into 5 million shares. There are 10 million shares outstanding. If we have 5 million more that we can convert into, there will be 15 million in total. But our converted shares will be 5 out of 15 million, so will be actually 1/3. Okay, so it's gonna be, we're gonna have a line like this with a slope of 1/3. Okay, and now let's draw the payoff diagram of a preferred stock, which we have already done. A preferred stock looks like this, right? Remember the preferred stock that we have with the preferred value of 5 million at liquidation. Okay, so after that point onwards, okay, the preferred stock was giving us nothing, right? It would be like this. That would be the purple one is the preferred stock, redeemable preferred. The green dotted line is the converted equity. So what is the value of the convertible preferred is this blue line, which is going to be this, and then after this point onwards, you will choose to convert, which was $15 million, if you recall our lecture from first day. So the blue is going to be the payoff diagram of the convertible preferred. Okay, that's the blue line. All right. So now, what is this convertible preferred? It actually looks like a senior claim, this part. Let me mark this with another color, let's say purple. So this part looks like redeemable preferred. Okay, but this part looks like a warrant. Yes. So therefore, a convertible preferred stock is nothing but a redeemable preferred plus number of warrants. Number of warrants such that you get the upside potential, 1/3 of the upside potential after $15 million firm valuation. Okay. So therefore, a CP is nothing but a redeemable preferred plus warrant valuation. And that's how we will actually price all these options, whether they are convertible preferred or participating preferred. The formulation will differ, but it's going to be a bunch of warrants and call options, okay? Added, subtracted, depending on the exoticness level of the complexities of the security. But a convertible preferred is simply a redeemable preferred plus a warrant. So we have to understand how to price a warrant. Okay, so far so good. So let me save this and then stop sharing, and I'll share this with you at the end of the lecture. So now let's try to make sure we understand how to price a a warrant, because in order for us to do anything, we first have to learn how to price a warrant. Okay, in what follows, okay, I am going to teach you how to price a warrant, and then we can quickly move on to how to price a convertible. In fact, seen it, once you have a warrant, everything else would be easier. So the next 15 minutes, I'm going to go through this slide deck, but I have to warn you, this is rather complicated. If you try to read this from textbooks, you'll get confused fairly quickly. I'm going to teach you in a somewhat innovative way that I find very clear for non-experts. But it is somewhat of a pedagogical style that I have developed. But this is something you may or may not be able to find in other sources. But bear with me, okay? So this is, I will call, a simpler approach for warrant valuation, because in a textbook you can see you can actually do this in a very rigorous, complicated way, but it takes a couple of weeks to kind of go through the derivation. So this is a very simplified approach. So we like to price warrants with a strike price of K and maturity date of T. Okay, so 3 months later, our stock options, which we call warrants, are going to expire, and we want to find the market price of those. Let's assume I'm an executive of a company. The company had issued some stock options to me. I want to see what is it worth. Okay, it's an exercise like that. Or it could be that you're being offered to buy these warrants from the company, and they're not public data. You need to find what the value is. Okay, so current date today is denoted by small t. The capital T is the future maturity. Let's say 6 months from today. Small t is today's date. There are M warrants and N common shares, right? So the company has offered me M stock options, right? Let's say there are 100 million shares. They gave me 1 million warrants. I want to find the value of those. M is 1 million, N is 100 million. Let's assume that, all right, as an example. So S is the stock price and capital T is the maturity date. So when I write ST at subscript T, is going to be the stock price at maturity, which I don't know, right? It could be high, it could be low. Only God knows what it's going to be, if God exists. Okay. But I'm going to make it distinguish. I'm going to distinguish two different kind of prices. Whenever I put star, that's the real value of the common share on terminal date. Okay. When I don't put a star, it will be the hypothetical case. What would have been the value of the common share at terminal date if there had been no warrants outstanding? Well, the thing is, there are warrants outstanding. I was given those by the company, so they exist. But what would have been if they didn't exist? So that's going to be very important understanding this. Okay, it's a little hypothetical, but bear with me. Intuitively, which one's going to be higher, ST or ST star? ST is going to be higher. Why? Because once there are warrants outstanding, the stock price is not going to go up as much as it could have, because as the stock price goes up, the investors realize that now it is more likely for these warrants to be exercised, diluting the upside potential. Anticipating that dilution, whenever good news comes in, the stock price doesn't go up as much as it would have if there had been no warrants outstanding. Okay, so there is a link between those two things, and we will need that link fairly soon. All right. All right, so now let's do a little math. When is it going to pay to exercise these warrants? Okay, it's going to pay to exercise these warrants if after we exercise the warrants, the stock will be worth, if the stock is worth more than the strike price itself. Otherwise, we wouldn't want to exercise. Why would we? We're not idiots, right? So let me first calculate the stock price, the real stock price, okay? post-exercise. The value of the total equity is this much, okay? There are two different ways of finding the value of equity before exercising these options, okay? In the hypothetical case, there are n shares, and at maturity, each one of them is worth ST, so that would be the value of equity. But it's also equal to this hypothetical case in which the sum of that equity value is captured by the warrants. So there are M warrants. W denotes warrant value at maturity, and there are N real stock prices. So those two things would be equal, okay, because they're going to be worth the same common value of the equity of this firm, okay? All right, so keep that in mind. So I want to go with the first. The value of the equity before exercise is going to be N times ST at maturity. But when I exercise my warrants, I need to get, obviously, N new shares, but to do that, I need to pay M times the strike price K. So this is the total value that I pay to the treasury of the company. Therefore, now the equity is worth more by M times K because it's how much I paid to the company in order to exercise my warrant. But as soon as I do that, number of shares goes up to N plus M from N. So I divide this by N plus M to find one single share's value post-exercise. All right? So I divide both numerator and denominator by N, so it becomes little handsome, where lambda is going to be M over N. Okay? So now this looks interesting. The stock price at maturity, the real price, will be equal to the imaginary stock price plus lambda K divided by 1 plus lambda. We call this lambda, in fact, the dilution factor. All right? Okay, now let's move on. So in order to exercise this warrant, this real stock price, ST star, has to be greater than K. So if it is greater than K, the warrant is valuable, right? And the value will be this much. But if ST is less than K, we would be idiots to exercise the warrants. These warrants will have zero value. Okay? But let's try to calculate this. What is this? It's positive if ST is greater than K, but what is it exactly? Let's calculate this. So what happens is that in order to do this, let me do the math a little bit here. Okay, ST plus lambda K divided by 1 plus lambda minus K. While this K is going to be multiplied with 1 plus lambda to go into the numerator. So this will be ST plus lambda K minus K minus lambda K divided by 1 plus lambda. Lambda K's will cancel out each other. So this would be ST minus K divided by 1 plus lambda. So therefore, the value of the warrants is nothing but ST minus K divided by 1 plus lambda if ST is greater than K. And if ST is less than K, it's worth 0. Okay? All right. But what would have been the value of a call option? The value of the call option would look like ST minus K if ST is greater than K, or 0 if ST is less than K. So it looks like this call option and warrant are very related to each other, except warrant is a little smaller, divided by 1 plus lambda. Let's move on. But one thing you should note is that this call option is written over not the real stock price. What is ST? It's the imaginary one. No warrants outstanding, right? This would have been the share price if there had been no warrants outstanding. So that's why we actually defined this term earlier. It seemed a little crazy. But now it looks like a warrant that exists in the real life are worth a call option divided by 1 plus lambda. But this call option is what would have been the call option if there had been no warrants outstanding? It's a little weird, right? The warrants do exist, and in order to price them, we have to find the call option that would have existed if there had been no warrants outstanding. So it's a little strange. Okay, but that's basically what we need to calculate. All right. If you are with me now, and if you think you followed me, great. This is a psychological treatment. I could have simply told you this is the formula, memorize it, but instead I want you to understand where it comes from in a very simple, intuitive approach. Okay. So warrant, therefore, is nothing but a call option divided by the dilution factor, and that call option is this hypothetical call option. If what would have been the value of that call option if there had been no warrants outstanding. Okay. Now, we can therefore price this thing using Black-Scholes. Why? Because we knew that call options is nothing but a Black-Scholes formula with all these ingredients in it, right? So therefore, the warrant is going to be this Black-Scholes formula divided by 1 plus lambda. There are, however, some challenges. The biggest challenge is due to the fact that this call option is not the real call option that we see in the real world. It's the hypothetical call option where there are no warrants outstanding. So we need to now worry about this. The underlying asset, therefore, is the current stock price, but it is the current stock price would have been if with no warrants outstanding. Okay, so that basically is really problematic for us, because in the stock market data, I have access to the spot prices. So today I know how much the stock is worth, but I don't know how much it would have been worth if there had been no warrants outstanding, and that's what I need. Similarly, I need the underlying assets volatility. Okay. But I want the volatility of the hypothetical case if there have been no warrants outstanding. In the stock market data, I know the volatility through historical data, but the historical data belongs to the real stock price, not the imaginary stock price without warrants outstanding. But there is additional complexity because historical volatility is not that useful for us, because warrant pricing or option pricing is forward-looking. It really asks us what would happen to the company in the future, how volatile would that underlying stock would be. Well, that I don't know because I don't have a crystal ball. In order to price this thing efficiently in the marketplace, I need to know market's perception of volatility. Historically, this might be have an annual volatility of 60%, but what is it going to have in the next 6 months while I'm holding this option? If the historical volatility is a good proxy for future-looking volatility, great. But if it isn't, it's not that great anymore. So what kind of volatility will I use? Where is that market's perception going to come from? How would I know? All right. Strike price, maturity date, and risk rate are easy. There'll be no complexity on those. So these would be the two things. What is the imaginary stock price? What is the volatility? And those are the two challenges that we need to tackle in order to price this thing. All right. And most practitioners usually do the first one. They don't worry about the second one well. I mean, they do sloppy work at it sometimes. Okay. All right. So I've already mentioned the relation between the real stock price and the imaginary stock price. Remember, I drew these things. This is the total value of equity of the firm. Okay. And they're equal. One of them is N times ST. The other one has M times warrant T. This is supposed to be a W times ST the star. Okay. So therefore, N times ST has to be equal to N ST star plus M times warrant. Therefore, the imaginary stock price is nothing but the real stock price plus lambda times warrants. Okay. The problem with this is that we need to plug this baby here in the Black-Scholes formula. As soon as I do that, in order to price the warrant, you're going to say, oh my God, in order to price the warrant, I need the value of the warrant. So it becomes a chicken and egg story, right? In order to find the warrant, I need to plug in the warrant's value already. Then what good does it do? But this just looks like something like this. X is equal to f of x, x being the warrant price, and f is a function. This is a one equation, one unknown. It's one hell of a one unknown equation because Black-Scholes is rather complicated. But as long as f is well behaved, for those of you who've studied math in college or in the graduate level, I guess undergraduates wouldn't know this, there is these things called fixed point theorems. As long as f is a well behaved function, such a function has always such an equation, always is a solution, and Black-Scholes formula actually satisfy those niceties of the functional form, so you can actually solve this thing. This becomes one equation, one unknown, it is solvable. Not by hand, obviously we're going to do it on the computer because Black-Scholes formula has very complicated equations in them. But all right, so that's how we would treat it. Once we price the warrant, then we know how to price the convertible. You can price the convertible bond, you can price the convertible preferred stock. That stuff is easy. All right, let's now do this in the exact spreadsheet. All right, so I'm going to do everything that we've discussed in the next 25 minutes in an exact spreadsheet, and you'll have access to those exact spreadsheets and you'll be good to go. All right, let's first do the Black-Scholes formula. All right, let me make this slightly bigger. All right, so now we are going to value a call option and a put option. But put option, unless you really want to know, I don't think it's needed for this lecture. But if enough of you want to learn how to value put option, it'll take me extra 5 minutes to teach you. I mean, obviously the equation is there, it does it automatically for you, but I'll teach you the background information, the logic, intuition behind it. So we want to price a call option today. Today is December 31st, 1997. This was the first year I started teaching at the Wharton School. So this is, you can see I prepared this lecture notes at that point when I was a young man. Anyways, the maturity date is February 20th, 1998. Most options expires on the third week of certain months, but these are real numbers, but you can price it at any date. That doesn't matter. Okay, so what am I going to do now? I'm going to say, okay, I know T. The difference between those two dates is going to give me the T. Okay, that's great. All right, T is basically 0.397 years. That's great. I now look up the interest rate. Okay, what is the US Treasury with that maturity is have a yield? It has a yield of 4.95%. These are all annualized yields. Okay, and I look at the stock price today. Stock price is $104.05. No, not 5/8. I'm sorry, 7/16, but doesn't. I'm sorry, 9/16. I'm sorry, but doesn't matter. And the option that I want to price is a strike price of $115. Great. Then God gives me the volatility, and I'm not telling you where this volatility comes from right now. It says it's given to us, 39.6% volatility. Once you plug all those ingredients into your option Black-Scholes formula, those 5 ingredients, then actually Black-Scholes formula will give you the call value. Okay. In fact, if I may draw a little graph here, okay, the Black-Scholes call value is a function of volatility. Obviously, it's not drawn to scale, but it looks like something like that. Okay, it's has a little curvature. Okay, so for any volatility, let's say in this case is 39.6%, this Black-Scholes formula, given everything else is fixed this way, has a call option value of $2.74. In fact, you could do this and say, what if the volatility was 50%? What would this be? Well, let's change that and see what that would be. Okay, instead of 39.6, let me write 50 there. Boom, it goes to $4.21. Okay, that's how it works. So in other words, I could use the same Black-Scholes formula to ask you, Chris, for example. I say, Chris, if this thing is trading at $4.21, what is the market's perception of volatility? Through this Black-Scholes formula reverse engineering, Chris could have solved this equation and given this 50% volatility. Okay, so far so good. All right, now let's go back to our 39.6% volatility. Well, it's not doing what I asked it to do, but that's okay. All right. When stocks pay dividends, what happens? When the stock pays a dividend, dividend-based stock is losing value. Dividends are bleeding the stock. We need to adjust the stock price with the present value of dividends. The next page does exactly that for you. You subtract the present value of dividends from the current stock price to find the adjusted stock price. It's just going to work the same way. This is less interesting, and I'm going to leave this for you to play with. Okay, let's leave this aside. So far, so good. Now you know how Black-Scholes formula can be used to price the call options. How many people are curious to know how put value is calculated? In the Black-Scholes formula, when you click on it, there's an equation like this, and it just calculates for you. If you are interested in understanding the derivation of that, there is a link between a call option and a put option. I'm happy to explain. It's going to take us 5 minutes. If at least 2 of you raise a hand right now, the blue hands, I will do it. Otherwise, I won't do it. I'm not sure. 3 people raise their hands. Let me see. Okay. All right. Ooh, you guys are a curious bunch. All right. So I guess I will have to do it. All right. Okay. Let me now move here. This actually was invented by a Wharton professor way before my time. He's retired many years ago. It's called put-call parity. Okay. So we know that this is a call option, right? This is a call with the strike price of K. What is a put option? Let's draw that put option with green. This is the put option, the value of a put option, because the put options are going to be worth something if at maturity underlying stock is worth than the strike price. If it's 0, you're going to actually get to sell that option at K dollars, but stock is 0, so this is going to be exactly K dollars, the payoff. If the stock is worth K minus $10 at maturity, you're going to get to sell that put option, the option to sell the stock. I'm sorry, you're going to exercise that put option, the option to sell the stock at K dollars at K, and then you're going to make $10. Okay, so it just gives you wealth if the stock underperforms. And the call option is the opposite. It has value if the stock performs more than the strike price. Okay, so instead of this, what if I say I want the payoff of C minus a put? Then what we basically have to do is we have to flip this to the other side, like this. Okay, in fact, because it's negative of with the previous green line. Okay, therefore the payoff diagram of a C minus P looks like this. This is basically negative K here on the y-axis. But the straight line here, let me now draw this with a different color. This is a straight line here like this. What does it look like? It actually looks like a commitment, an obligation to buy the stock at K dollars at maturity. All right. So therefore, C minus P is nothing but the present value of a commitment to buy the stock for K dollars, right? 6 months from today, the stock is going to be worth ST, okay? And your obligation to buy the stock for K dollars will have a payoff like this. And today, I have to have an expectation about that. The thing is that expectation, I know what the true value of that stock today, that's today's stock price. So all I have to do is I have to find the expected value of K today, calculated via continuous compounding risk-free rate. Okay, so therefore C minus P is nothing but ST minus expected value of K, and that actually is here on the cell. Okay, you actually can calculate this using this. All right, so therefore the put itself is going to be, you can throw the put together and the rest of it, call minus ST plus the expected value of K dollars. Right? And that's what you actually see here. Okay? And that's called put call parity. Again, this would take about 45 minutes of lecture to teach in real class with full explanations, holding everybody's hands on, no one gets confused. I did kind of a speedy version for 5 minutes. All right, now let's move on to our warrant pricing, which is even more complicated. All right. All right. So the warrant is going to be, we will need to solve this circle relationship, right? BS is going to give us this call option, but the warrant is going to be this BS divided by 1 plus lambda. And this lambda is M over N. Okay. Number of shares is 100 million. We have 10 million shares of these warrants. I'm sorry. We need to calculate the warrant price. This we don't know right now. Okay. In fact, if you click on it in the exact spreadsheet on that thing, it's going to actually refer to cell B23. It's where at the end of the day what we calculate. So it's going to be a circle relationship. All right. The risk-free rate is given by this much. Time to maturity of this option is given this much because the valuation date is now January 31st, 2000. I want these warrants valuation, which expire in 16th of July of the same year. I know the stock price. Now the stock price will be adjusted. What is the adjusted stock price? The adjusted stock price is going to be the real stock price plus lambda, the warrant price, except the warrant price is given to us here, but which we don't know. So if you click on this, you'll see that we'll be referring to cell B7, but B7 itself is unknown. So as soon as you type this in your exact spreadsheet, Excel will warn you that you have a circle relationship. So yes, I know, don't worry about it. The strike price is $55. The volatility, God gives us the volatility for the time being. I'm going to address where I find that volatility later. Once you plug everything this, the exact spreadsheet is going to give you the BS call value and the warrant value. Effectively, exact spreadsheet is chained to do this approximation method, which you can play the parameters with. It comes with default, use the default, that's good enough. Through iterations, it actually solves this one equation, one unknown. What is it solving? It solves this equation, right? Because Black-Scholes formula had the warrant price in it. So as I explained, this x equal to f of x kind of a function, it's solved by the computer automatically, okay? If you use my exact spreadsheet, you don't need to do anything, just plug in the numbers because this platform is built to solve it, and I've already answered the questions as to how the approximation needs to be done. I customized it, everything. But so if you're gonna use exact spreadsheets to value warrants in future, use mine. Don't do it from scratch because it's gonna keep asking you awkward questions, okay? About how do you want this approximations to work and things like that. So, all right, that's how you actually calculate the warrants. So far, so good. But why on earth I use 40% volatility? What I want is market's perception of volatility. How do I calculate market's perception of volatility? For me to find market's perception of volatility in the next 6 months, there has to be a publicly traded call option or any option for that matter that is traded in the public market so you know the value. Remember when I drove a call as a function of volatility, there's a relation like this. Instead of plugging the volatility, if I know the price of a call option that is publicly traded, I can actually reverse engineer and find this implied volatility. Okay? And that is already done for you. Okay, let me go to this implied volatility and let's solve this. Let's assume we have a call option that is publicly traded on this company that is also expiring, okay, on the same date. You may, if you're really careful, you may say, Bilge, this is the real company with warrants outstanding. I want the volatility of the imaginary company with their no warrants outstanding. I hear you, but just hold on to your guns for the time being. Okay. All right. So this company has a publicly traded call option. It's trading at $5.25. Okay. What is the implied volatility that is given that $5.25? So in other words, I have this thing. It's trading at $5.25. This is the call option according to Black-Scholes formula. Black-Scholes formula, therefore, implies a volatility. What is that? I want to calculate that. This is how we do it. In the very first page, I have the commands here, okay? And I'm going to execute that for you. All right, so what you do here, there is this thing called what if analysis. Let me get rid of this. What if analysis, and you hit the goal seek. It basically asks you, say, okay, which cells will you be changing? I want to be changing this cell, the volatility, because I want to find the volatility. By setting the cell B16, this cell, okay, like this cell, okay, to which value? Okay, now let's pick a victim. Jose, you show up first in my screen. Why don't you just tell me a value? Which public trade value we have? We have 525. Just quote me another number. Any number is good. $6. Okay. If the public traded option is worth $6, what would have been the volatility? You say, okay, and it goes to 45%. Basically, if this is $6 here, okay, if this thing is actually $6, this implied volatility would have been 45.51%. That's how you calculate the market's perception of volatility. You need to have a publicly traded call option with the or the put option, or any option for that matter, that has is publicly traded with the same maturity. Then as long as you know the publicly traded price of that option, you can plug in back and find the market's perception of volatility. Having said that, real life is a little complicated. Many of the warrants, like stock options, have very long horizon, 5 years, 6 years. Usually many warrants or call options or put options that are publicly traded are up to 6 months. So it creates a problem. So one mistake a lot of people do is they say, okay, publicly available options that are traded have a maturity of 6 months. I'm going to calculate market's perception of volatility, and I'm going to assume that volatility is going to remain constant for the next 5 years. Big assumption. And sometimes it gives you very bad answers, but you just live with that. You just need to know limitations of your approach. Sometimes companies have publicly traded warrants. Sometimes they have publicly traded convertible bonds. They will allow you with long-term, long horizon, they will allow you to calculate the long-term market's perception of volatility. That would be a good job. It will do a good job on pricing these non-traded warrants with long maturities that way. Okay, so far so good. So we're all ready now. If you want, you can take these Excel spreadsheets and price anything you want. Having said that, many of you won't, but this at least gives you an idea what is in the black box that David is going to share with you. In David's analysis, the black box has already chosen your volatility, so you don't need to worry about it. There's a good and a bad news about it. Good news is that you don't need to worry about it. You're just going to plug in the futures of your exotic security. It'll pop you an answer. But the volatility that black box assumes is an average venture-backed company's volatility. If you want to fine-tune that, you say, you know what, my company has higher volatility than an average VC-backed company, then I expect these options to be more valuable, a call option or a warrant. But how much? Well, for that, you need to build your black box. And I'm basically giving you the ingredients of that black box. All right. So far, so good. Any questions? we're done. You actually survived a lecture. Probably would have taken 3-4 weeks of content in a real class time. I really breeze you through it to expose you to the ideas. And now you have access to all the goodies, so you can do whatever you want with it. If there are no questions, I will let you guys go. So this was quite a bit of a...
Thank you.
Can we do a real example? Just like if we look at the one real example now in the market.
Sure. In fact, let me open the exact spreadsheet. You tell me what real example you want to do. As long as you plug in the numbers, it'll give you that. Would you like to price a stock option? Would you like to price a call option?
Sure. Let's look at the Apple. The current value is 129.18 cents.
All right, let's do that. All right. Let's play with this. What is the current value of Apple?
129.16 cents.
Okay. All right. So which option you want to price?
Call.
Call option. But when is it maturing? What's the strike price?
I'm just checking now. The strike price is, the expiry is 15 January. And the strike price is 75.
$75?
Sorry, let me double check this. The code. Yeah, 75. Yeah, 75.
That's going to be a very valuable call option. That's okay. Now let's do the time to maturity. Okay, time to maturity is 4 days basically. You said 15th of January, right?
Yeah, 15th of January.
All right. Okay, risk-free rate for the next 4 days is effectively 0%, but let me at least put a non-zero number there. Okay, tiny risk-free rate. Okay, what is the volatility of IBM stock, you think?
Volatility.
We can reverse engineer from a public price. Let me say that it is 50% volatility. This annualized, it won't be way off. Don't worry. 50% is a good estimate.
Okay.
And then the BS call value should be around $54.16.
Yeah, it's 54.35.
Yeah. The reason the difference is mostly because the volatility is different at 50%, not 50%.
Okay.
Right. So that's how you price this. Okay. When you do this to Black-Scholes, okay, Black-Scholes formula, you'll be shocked that the price is going to be very, very close to what you see. In the data, there's something called smiley effect. Okay. Deep out of money and deep into the money options are slightly off. But other than that, it does a fairly good job anticipating market prices. Okay, all right, that's how you do it.
Thank you.
All right. Thank you for the question. All right, thank you for putting out with me. This is, as I promised, this being the Wharton School, I don't want to shortchange you, so I want you to learn everything we offer to our degree students. But this was somewhat of an adventure in 45 minutes or an hour. I guess it's been an hour. Thanks for putting out with me, and enjoy your rest of your day. Now I'll just pass the buck to Christina.
Thank you.
Thank you.
Thank you.
Thank you.
Thanks, Bill Gay. Okay,
Thank you,
everyone.
Bill Gay. Thank you, Bill Gay.
Thank you.
Thank you.
Thanks, Bill Gay. Okay, we'll see you tomorrow at 9:30.